So as agreed this morning in private session, and before we deal with item number 7, which is the main business of the meeting, if members wish to comment on the nurses' action in the last years, you can do so. Senator Conway.
I think it's very important indeed that all committees, but particularly this committee, send solidarity with the nurses. I know none of the thousands of nurses who were on the picket line yesterday wished to be there. They wanted to be in delivering the treatment within a safe system. And I think that is the key to it, the recruitment and retention issue. We cannot expect nurses to work under the terms and the conditions that they're being expected to work on. And I would plead with the Minister, with the Taoiseach, to intervene to sort this out, because I'm very mindful as well of the almost 25,000 patients who maybe some of them have waited years and months to get their treatment, who had their appointments cancelled yesterday. And that is not right in a state like this, and we have to do everything we possibly can to stop it happening. I'm also aware that today we have the psychiatric nurses not refusing to go on overtime, which is absolutely within their right. But again, I think it highlights the chaos within the system. So this is going to escalate unless the government intervenes, and they need to intervene now, because they're going to have to intervene at some stage anyway and sit down and work this out. So sooner rather than later, before other appointments have to be cancelled, I would urge everybody that has anything in their remit to be able to change this, to change it. But I do commend the nurses, and I commend their bravery, because it wasn't an easy thing for them to do, knowing all those appointments and operations and procedures were going to be cancelled yesterday. They don't want to be on the picket lines, and certainly I don't want to see them on the picket lines.
Thank you very much, Senator. Deputy Murphy.
Thanks a lot, and it's a good idea to have this brief session. Obviously, Minister Donoghue is coming into us next week, and I would hope that by the time he comes in, that the situation is resolved and the government has, and the HSE have given a meaningful indication that they're willing to move substantially on the question of pay restoration and pay parity. I think if the government doesn't do that, they'll be making a very big mistake. I was on 4 different picket lines yesterday, and the public support is phenomenal. It really is. It's something unbelievable in terms of the amount of cars beeping and so on, expressing their support. So that the public support is phenomenal, but also the determination of the nurses and midwives to continue with their just struggle if there aren't substantial concessions, and to go ahead with the 2 days of strike next week, which will cause even more disruption, which obviously the nurses and midwives don't want to do, but they have no choice, would go ahead next week. And I would also say that the argument of the government that they can't afford to pay them, etc., doesn't get very far with the nurses and midwives, and doesn't get very far with the general public. And something I would intend to ask the Minister next week is the amount of money that was paid to the junior bondholders who refused to get burnt just before Christmas is about precisely what it would take, according to the government, to pay the nurses and midwives pay claim. And so they're able to find the money for the bondholders but can't find the money for our health service. And I think there's very broad public support, because people understand, obviously nurses are on the front line of an underfunded, quite disastrous in many respects health service, and it's the various health professionals in the health service who are the good thing about the health service when people interact with it and they understand the difficult circumstances that they're in. People understand that a win for the nurses would be a win for all workers, and also that it would be a step towards the kind of investment that we need in building a national health service in this country. So I hope that we don't have to get answers from the Minister next week, but if we do, I think we should be prepared for a lot of questioning and so on. Thanks.
Okay, thank you very much, Deputy.
Chairman, I welcome the fact that the Minister is coming in next week, and I would hope by the time the Minister comes in that this issue will be resolved. I think that they have no choice, but they all have to go back to the negotiating table, and I would hope that they will do that immediately and bring a resolution to this whole issue.
Thanks very much, Senator. Well, the purpose of giving the members the opportunity this morning to air their views is because this committee deals with public expenditure and reform, and part of its remit would be the agreements on public pay. Having witnessed the nurses working at first hand, I think any of us would agree that they're at the coalface, that they're understaffed. I think that the pay situation has not been what it should be and has been allowed to drag on for a long number of years. This House in particular has overlooked the real issues in the context of the nurses. There has been no real debate about public pay in this House, and I think there should be. Next Tuesday we'll have the Minister before us and we can deal directly with him in relation to these matters. But as someone that was on the picket line yesterday in 2 different hospitals, yes, they were talking about pay restoration, pay parity and the conditions of their employment. And they brought to my attention the health and safety issues on many of the wards throughout the hospitals that I was at, and indeed throughout the country. So there are safety issues and there are staffing issues. And it's clear from the messages that are being sent from abroad, from Irish nurses that are working abroad, that they would prefer to be at home. And I was struck by some of the comments by those that did come back, to say that they've come back from a different health service to one that is way behind the standards of what it should be. So it gives us the opportunity next Tuesday, as I said, to highlight these matters. And I would say just two final things. In terms of the patients and the waiting list and those that have been cancelled, I would ask them just to bear with it. I know that it's difficult, but at the same time, this is about a long-term issue in terms of safety and pay. And secondly, when I was on that picket line yesterday at St Luke's in Kilkenny, some of the nurses actually went in to the hospital to relieve some of their colleagues and to deal with some emergency issues that arose. So it's not as if they're ignoring their patients. They're not. The strike is about patients. It is about nurses, and it should be resolved. And the politics of this House, is such that it is, in my opinion, ignoring the issues at hand. And it should be about a debate, a discussion about the whole thing, and resolution rather than going further. So I want to thank the members for their contributions. And we can now move to item number 7, and we'll suspend while we're waiting for the guests to take their seats. And before we come to item number 7, I want to record the following decision of the committee regarding EU proposals. The decision taken by the committee on EU legislative proposals, proposals COM 821, 832, 812 and 819 do not warrant further scrutiny. Full details of the decision will be published on the committee's website. So item number 7 then is engagement with the final report of the COAC implementation group. I want to invite welcome all of the guests here this morning. Mr. Carr, Department of Finance, Mr. Farrell, Irish League of Credit Unions, Mr. Kevin Johnson, Credit Union Development Association, Mr. Tim Molan Kuma, Mr. Joe Tobin, Treasurer of the National Supervisors Forum, to our meeting to discuss the report. I wish to advise the witnesses that by virtue of Section 17(2)(I) of the Defamation Act 2009, witnesses are protected by absolute privilege in respect of their evidence to this committee. If you are directed by the committee to cease giving evidence in relation to a particular matter and you continue to do so, you are entitled thereafter only to a qualified privilege in respect of your evidence. You are directed that only evidence connected with the subject matter of these proceedings is to be given, and you are asked to respect the parliamentary practice to the effect that, where possible, you should not criticise nor make charges against any person, persons or entity by name or in such a way as to make them or is identifiable. Members are reminded of long-standing parliamentary practice to the effect that members should not comment on, criticise or make charges against a person outside the House or an official either by name or in such a way as to make them identifiable. I want to invite Mr. Carr to make your opening statement, please.
Thank you. I'd like to thank the committee for inviting the Cook Report Implementation Group to attend this meeting to discuss our final report. As he has stated, I'm accompanied today by the credit union representatives of the Implementation Group, namely Ed Farrell, CEO of the Irish League of Credit Unions, Kevin Johnson, CEO of the Credit Union Development Association, Tim Molan, Chairman of the Credit Union Managers Association, and Joe Tobin, Treasurer of the National Supervisors Forum. The Central Bank representative on the Cook Implementation Group, Elaine Byrne, is not present today. However, the Central Bank has indicated that the Registrar and the Deputy Registrar, Elaine Byrne, are available to attend the committee if it wishes to extend them an invitation on another occasion. I'd also like to note the positive contribution of Joe O'Toole, who attended a lot of our meetings as a Cook observer to assist our understanding of the Cook report, which was issued in 2016. As the committee is aware, the group has its origins in the Cook report, which was issued in mid-2016. This report was requested by the Minister for Finance at the time and was presented to him in June 2016. The Cook report contained 10 recommendations, along with an overarching recommendation to establish an implementation group for a specified period of time to oversee and monitor the implementation of the recommendations and to advise the Minister for Finance on progress. As such, the implementation group was established under a tight terms of reference and was not tasked with addressing legislative or regulatory issues facing the sector other than those recommended, namely tiered regulation, lending, consultation and engagement, governance, restructuring, business model development, and 3 additional policy papers on interest rate ceiling, AGM voting and common bond. The name Implementation Group is a slight misnomer, given that most of Cook's recommendations could only be fully implemented by the Oireachtas, the Central Bank or by credit unions themselves. The Implementation Group therefore worked on progressing each of the recommendations as much as possible and monitoring those which were being implemented. We met 18 times during 2017 and 2018, working through each of the recommendations, prioritising work on Recommendation 2 in relation to lending, Recommendation 3A, which was consultation and engagement during 2017. In addition to the final report, 3 papers were completed by the Implementation Group, 1 on lending, 2 on engagement and 3 on tiered regulation, all of which were submitted to the Central Bank and 2 of which were submitted to this committee. It is important to note that while these papers and the final report represent a collective view of the group, they are without prejudice to the individual views of the organisations represented on the Implementation Group. I believe in relation to the final report, it's a considered document reflecting a balance of different views amongst the stakeholders involved. In terms of the implementation of the recommendations, as you will have seen, while some of them have been progressed satisfactorily or are being recommended for implementation, others have not, as there were cases where the members of the Implementation Group did not agree with the Cook recommendation or felt it was of lesser priority. As the final report outlines, main progress has been on the following 4 issues. In terms of lending, the group's scoping paper was fully considered by the Central Bank in its current consultation paper on lending regulations, CP 125. The Implementation Group would hope that some matters proposed in the paper which were not taken on board will be reconsidered during the consultation. The Minister for Finance has agreed, subject to Cabinet approval, to bring forward proposals to increase the interest rate cap from 1% to 2% per month, in line with the recommendation of the Implementation Group. Such a cap provides further flexibility to credit union boards. It is not intended as a target or to express any desire for them to raise rates. In terms of business model development, a range of collaborative ventures have been progressing towards implementation, many more than when CUIC initially prepared its report in mid-2016. The consultation process for regulations has improved, though further refinements can be made over time. On the negative side, while central bank engagement with the sector has improved both formally and informally since the CUIC report, both the implementation group and CUIC itself are disappointed that a version of the CUIC proposal for service level agreements between the central bank and credit unions has not been introduced to date. This is wholly a matter for the central bank in its role as statutory independent regulator of credit unions. Another recommendation which has not been progressed in line with the CUIC recommendation, namely tiered regulation, deserves further explanation and has been a consistent issue for the sector since the Commission on Credit Unions, as I'm sure you're all aware. While proportionality and avoiding a regulatory framework which is one-size-fits-all is supported by all members of the implementation group, after careful assessment, the group decided to propose a different approach than what was recommended in the CUIC report. Developments in the sector, such as tiering and investment and lending regulations in recent times, and refinements in supervisory approach, led the implementation group to conclude that a form of this approach should continue, with tiering introduced within central bank regulations rather than through a formal tiered regulatory structure, which would divide the sector in two. Such a recommendation was accompanied by a number of principles, which include not restricting any credit union from services or limits they can currently provide, automatic inclusion in higher tier for credit unions of certain size and risk profile, and clarity in the approval process. This is a pragmatic change in approach, which may better serve to meet the needs of evolving credit union business model demands and reflects a different environment to that encountered when CUIC prepared its report. This recommendation is, of course, dependent on sufficient tiering being incorporated into all new regulations and a clear and transparent approval process where relevant. The implementation group agreed that failing this, tiered regulation could or should be revisited. The change in approach reflected in the report doesn't conflict with the sector's call for proportionate regulation and supervision, details of which are set out in the Credit Union Act 1997. As you may have noticed, Appendix 2 of the final report is a cross-reference to your own report on the review of the credit union sector. This is intended to identify those aspects which were addressed by the implementation group and those aspects which were outside the scope due to the terms of reference I mentioned at the start. The final report also sets out the many positive developments in train with the 2019 roadmap, which points to the material regulatory changes that are either bedding in or due to come into effect over the short term, and the imminent expansion of services and products for a large cohort of credit unions. As the section points out, 2019 could be an important year for credit unions, with up to 50 of the larger credit unions encompassing greater than 50% of sector assets moving forward with current accounts and debit cards, as well as the sector-wide potential expansion of mortgages and the further rollout of agri-lending. Notwithstanding this, there are emerging issues and challenges facing the sector which are summarised in the penultimate section of the report and which may be subject to additional work by stakeholders individually or collectively. To conclude, I'd like to say that the final report is not an endpoint, but rather a staging post with much done but more to do. And as demonstrated by the 2019 roadmap, the year promises to be a busy one for the sector and all the stakeholders involved, including the representative bodies with here today. There will be new regulations coming from the Central Bank following its review of the lending framework and new proposed legislation in relation to the interest rate cap subject to Cabinet approval and Oireachtas processes. Thank you for your attention.
Very much, Mr. Carr. This is the only opening statement, so if members have any questions.
And thank you for your presentation. I just want to ask you at the outset, how would you describe the relationship between the central bank and the credit union sector?
From my perspective, I've been involved with the credit union sector for the last two years and tangentially involved a little bit before that. The colleagues either side of me will go into the details, but I would say it is an improving relationship. There has been a lot of energy and engagement by the central bank in recent times. They have facilitated us, both Department of Finance and the CURC and the implementation group, with access to information, detailed understanding of why things are happening. We won't always necessarily agree with them, but I would say the relationship is pretty positive, collaborative. And I suppose in terms of the detail of how credit unions interact with the central bank on a day-to-day basis, probably best left to the representative bodies to discuss that, which we wouldn't have sight of.
Okay. It's just that obviously we're in a situation where the credit unions have assets of over 17 billion. And those assets just sitting there really aren't of any use to anybody. So they can be used in two ways, as have been identified within all the reports. Well, in several ways, in many ways. But for me, particularly around housing and around the microloan situation, so you're dealing with two very major societal problems. The first one being homelessness and people's right to own their own home. And the second one is the protection of citizens from scurrilous moneylenders who are charging hundreds of % interest rates. So the credit unions can play a big role there. So maybe we'll just look at the microloan situation for a moment, because I think it's a really good situation where somebody who maybe doesn't have a good credit record, and often through no fault of their own, maybe they got into trouble during the downturn, or they lost their job, or whatever, that they don't have the credit record that they would need to borrow from other financial institutions. And they can do under the credit union system by the repayments being connected to maybe their social welfare payment or that. So why is it that such a low number of credit unions are operating this microsystem? So in Mayo, for instance, we just have two of the credit unions that are able to offer that loan system. Could you just speak to that to me for a moment? I know you've referred to, I think, in one of the reports as them being a loss leader, but maybe just talk to me around the interest rates and what would need to be done in order to make that viable for all credit unions.
I suppose I'll touch on a little bit of it. The It Makes Sense scheme, the personal microcredit, is run by the Department of Social Protection. Obviously, that only applies to people who are getting social welfare. Yeah. It's worked through with An Post, so there's a reasonable relationship there. So it only applies to those borrowers, and there are other low-income borrowers who credit unions would obviously lend to in the normal course of business. When Department of Social Protection and the credit unions are involved in saying why aren't more credit unions doing it, there are a whole variety of reasons, including interest rate, potentially charges related to the process, administrative cost for what are very small loans, so they're a few €100 for a very short period of time, so they're paid back quite quickly. So the amount of money is very, very small. So there are quite a few issues which maybe my colleagues either side will touch on. So where we came down in the report in relation to the interest rate cap specifically, we recommended as a group that would be increased from 1% per month to 2% per month. It wasn't wholly tied to that cohort of borrowers who were in the personal microcredit scheme. That interest rate cap applies to all credit union lending, so we were recommending it be increased for all lending. We saw that one of the main reasons is to give boards the flexibility to be able to price slightly higher if they want to. It will be a board's decision whether they want to or not. That would go some way towards meeting the higher costs of some of that small lending, but it mightn't go the full way towards it. It's only one of the reasons why credit unions might not get involved in that scheme. So I don't know, Ed, do you want to touch on some of the reasons you see on the ground from your members?
That's a good, I suppose, synopsis of it. I mean, we have half the credit unions are already in the scheme, and we'd be fairly sure that would be more than, on a population basis, that would be more than half the population base of the country covered. A lot of the credit unions in the more urban areas would be in, so we were hoping to get more credit unions in, and I think Brian has explained the rationale there on the interest rate, so that would help some other credit unions defray some of the costs. It'll never be done to make money, as it were, but there is I suppose, duty bound in directors of credit unions to not lose much on a product line either, and not to be overly subsidising it. There is a I think it's a 25-cent per transaction charge from An Post to administer it. It's obviously very good that we were able to get the deduction from the social welfare, because that makes it almost like a secured loan, or it's like paying your taxes. The deduction at source is a much safer, and that gave, I think, comfort to everyone that the arrears would be much better than if there wasn't a deduction at source. So it's a matter of us encouraging more and more credit unions, and indeed we've always said it to deputies and senators, you encouraging them with us to open up that line in your local credit union if it's not open, because it's certainly something that we would like to see the whole country covered by, and certainly there's the independent UCC research on the interest rate caps right across Europe into money lending and the credit union cap interest rate, and all of them would say we have to have the country fully covered before we can expect to make a real indentation, as it were, into the money lending. So I would expect more credit unions to come on board, but I would like to, again, I suppose, stress that there is half the credit unions and more than half of the country covered. So in a 3-year period, we went from launching it, and there's 7 or 8 stakeholder groupings involved, including all of us here today, and then the department and An Post, and it has worked well from a standing start, and there is monthly meetings of those groups trying to make sure that we keep the momentum now that we have it, and get more and more and more families into this scheme, away from much more expensive and less desirable sources, I suppose.
Yeah, I would really encourage you to do that, because, say, for a county the size of Mayo, if you have only 2 credit unions operating in the area, it's impossible for people. Many of these people don't have transport, so access to a credit union, and obviously you have to work within your own locality as well. So I do think that, bearing in mind that we have over 300,000 people who are currently lending from reckless money lenders, I think that needs to be changed, and I see there's 2, I suppose, bodies I can see in addressing that, and that's beside the fact that we have legislation in around it. Pearse Doherty has legislation in to cap the money lending limits, but yourselves, the credit unions, as being the most trusted organisation, if you can bring people, into that space, working with MABs, because I think MABs, the Money Advice and Budgeting Service, do a wonderful job, and the most successful cases that I deal with are the cases where there is the combination of the MABs advice and the credit union supports, and that way people can really kind of get out of the traps, the financial traps that many of them are in, or from the exploitation of these money lenders. So I think it's hugely important.
Just to further on Senator Conway Walsh's question there, I think it's not simply about what the credit unions do and don't do. I think there is a case to be addressed around the whole area of money lending, and it's not just in the area of rates, it's in the area of practice. And it seems, for those of us like who will say would have people in a lot of the communities that are most blighted by this, that it is open season on the consumer. There is virtually no effective protection for people. Things like, for instance, the whole area of the Consumer Protection Code, it's not thought of, or it's not operated next, nigh or near to money lending. And one of the actual serious disadvantages or serious causes of reluctance by credit unions is the knowledge that the moneylender can swan back in the next week, and some of their mechanisms for persuasion and for collection are certainly not for the faint-hearted. And I think that we can talk and such about, and we can address things like rates and stuff like that all we want, but unless there is a more holistic approach to this whole area, from a legislative and from a consumer protection point of view and from a regulation point of view, we will still be sitting around here in 2 or 3 years' time asking the same questions and wondering why sufficient progress isn't being made. So
Yes.
I suppose the message is, you know, this has to be a more holistic approach.
Absolutely, and I do recognise that the bill that Pearse Doherty is putting forward is just to cap rates, if you like, and that's only part of the problem. And the thing that really worries me is that many of these people are not paying their mortgages because of some of the pressures and the practices that you talk about are put on them. So they're paying the moneylender the extortionate rates instead of paying their mortgages, and they're putting their homes at risk.
And they're paying them because these people show up on their door regularly, week in, week out, to collect the money. If I could make a further point there about the unpost charge. And look, unpost have to wash their face financially. But if, for instance, we'll say somebody commits to paying €10 per week, and 25 cents of that goes straight out and goes towards a charge, that account is going into arrears. And like part of the project here should be to rehabilitate the credit status of people. And I know it's a small amount, but it's still actually, and with the advocate or the whole issue of the CCR, the Central Credit Register and stuff like that, this is another area that does need to actually get addressed at some stage.
Johnson.
Just briefly to comment on that. I think as Mr. Farrell and Mr. Mullen have explained, you can see that there's a lot of work going on, and we are working collaboratively on it. And one of the things I think is worth noting is that you know, many credit unions are doing this and have been doing it for many years. So while it may look like only half of the credit unions are in this particular scheme, we are getting lessons from those who have been doing this type of work for many years. And indeed, the very foundation of credit unions was that to address the bigger problem where people could not get access to credit. So it's a core competency of credit unions dealing with these issues. If I might just touch on something, there were many parts to your question. So on the housing, that continues to be a very, very high priority for us on the credit union side. As you know, last February, the Central Bank did amend the investment regulations to allow credit unions to invest in a fund that would then lend on to Tier 3 approved housing bodies. Unfortunately, a month later, their status changed, and all of their sources of funding, irrespective of where they came from, are regarded as on balance sheet for the state. So that has introduced quite an unfortunate aspect to it. That said, our original approach to this would be that credit unions could lend for the purposes and not just to Tier 3 approved housing bodies, that they could lend to the likes of co-ops and other providers of housing. And it may be necessary to revisit that, to find ways where credit unions can collectively lend for those purposes, because the bigger issue here is the ongoing crisis, the fact that people cannot
How far away, and I'll just finish with this, here, like, how far away do you think we are from the credit unions being able to facilitate mortgages?
Well, it's happening already, and there are different mechanisms there. I know ourselves, we introduced a mortgage support framework to support credit unions doing it, and there's over 20 doing it now. They've processed roughly 44 million in home loans, average loan size around 110,000. So it is happening, and certainly it's what we're finding as well is that while some credit unions are able to offer a wide range of mortgages to their members, others are actually focusing on particular niches where people may not be able to access mortgage because perhaps the actual loan amount might be considered too small for a mainstream bank. Credit union more than happy to facilitate and look after their members there.
Yeah, I do think that needs to be progressed, particularly in light of the vulture funds and everything else that's going on in the free market.
Well, there is a very important consultation has just closed on the whole lending framework, and there's some very positive things in that. There's obviously some concerns we would have as well in it, and again we can explore that if you like. But that definitely will open up more potential if the credit unions can access the higher limits that are mentioned in that, and that there's a transparent way that can be done, then that certainly would open up the potential to serve more people on mortgages.
Did you?
Yeah, I think if you go back to the recommendations of Cork in mid-2016, and when we sat down as an implementation group, we would have said that the consultation on the review of the lending regulations was probably the highest priority item. That consultation is underway. The submissions have been, the submission deadline was the 9th of January, so the Central Bank have now received all the submissions from stakeholders, probably including yourselves. Just one other aspect, when those regulations do kick in, I think it's been very useful for the sector that the two representative bodies, either side of me, both CUDA and ILCU, have set up structures which will facilitate their members in doing something which is actually quite burdensome and complex for individual credit unions to do. So I think it's a really good example of where credit unions can collaborate, develop services which will enable other smaller credit unions to do things on a much more cost-effective basis. I think that's been very useful.
Okay.
Yes, Mr. Rowley,
just a final point on that. I think it is important to, like one of the points there that Kevin Johnson made is a very important one, and that is the one around collective lending and the difficulty with collective lending, whereas it will be, and I'm looking at the mortgage proposition at this point, for the larger credit unions, it will be easier from that perspective to do individual lending, but there still is there still is a huge need throughout the country to address areas like social housing, and that can only effectively be addressed on a collective basis. And there are significant difficulties in that area now that need to be addressed, if we are to advance that particular agenda. And I think that certainly bears closer scrutiny by your good selves.
Okay. Thank you. Thank you.
All right. Thanks, Senator. Senator Burke.
Yeah, thanks, Chairman. I welcome the delegation to the committee, and compliment him on bringing out a fine report. I just touch on the area in relation to liquidity and how the individual credit unions at the moment, how they survive, we'll say, a situation where there's a shortage of cash. And I see where you're proposing that you could go down the route of the Canadian model, where there'd be centralised liquidity for those credit unions. Could you maybe give us some background into your thinking in relation to this? And where does the individual credit unions that run short of cash at the moment, how are they coping? Because it would seem that it's an ad hoc, you say in the report it's ad hoc. So maybe in some occasions some of the credit unions might be able to get cash at some point in time. Would that be the case?
Yeah, I think this is, firstly, it wasn't in the terms of reference, so this is more in our future challenges work. So liquidity wasn't an issue raised in the Cook report itself, so we weren't dealing with it as a recommendation. I suppose what we were looking at there in the background is when credit unions have a lot of cash at the moment and they have a lot of things invested in things which you can get access to quickly, so government bonds, deposit accounts, so it's not a particular issue for credit unions at the moment. They're essentially over-liquid, which is partly one of the problems, putting money into low-yielding investments. But if we look forward, and if credit unions get involved much more in complex products, longer-term mortgage products, for example, which aren't as liquid, then I suppose what we're saying is we might need to look at liquidity and how credit unions do that in the future. There's very few credit unions who have a lot of loans outstanding compared to assets at the moment, so it's not an issue at the moment. But I suppose in legislation, credit unions can borrow, a credit union can borrow a small amount of money from another credit union, and a credit union can lend a small amount of money to another credit union. That is allowed in law, but the percentages, I suspect one of my colleagues here beside me will say the percentages are too low, but they haven't been needed at the moment, so therefore they haven't been urgently looked at. But there is that facility. I think what a lot of credit unions do, just to ensure they have sufficient liquidity, is to make sure that they have sort of available facilities from banks, but they get charged for that. So there's a cost to doing that, to make sure that you have your liquidity in place. So really, that's the background from my perspective as chair of the group. Kevin, do you want to? This is your particular issue, so.
Yes, Mr. Corr would be referring to myself there about those limits. It's just at the moment, as Brian has mentioned there certainly isn't any issue with regard to liquidity. I mean, the average liquidity level is 37% across all credit unions. But all the time what we're trying to do is future-proof and make sure that we have mechanisms in place. As you rightly mentioned, other jurisdictions such as the Canadian system would have central liquidity mechanisms, and really that's just a formal structure where credit unions can access liquidity should there be a short-term demand. And I suppose the concern we would have is that the inter-credit union lending borrowing limits are very, very low, so it really doesn't provide a backup line of credit, if you like. So therefore, a number of them are having to put those in place with banks and paying for the privilege. Even though they're not using it, it's still good, prudent management to have such a facility. So we would, and it's good that you've actually highlighted that, Senator, because that's something we'd certainly like to see in place. But it will require some sort of mechanism or indeed a revision of those limits.
What you're saying at the moment is that every credit union that's there has a facility someplace with some bank or other institution, and they're paying for it even though they might use it. Would that be the case?
Well, just to be clear now, not all would need it, would have that, but some of the bigger ones would put that in place. It would just be good, prudent management.
And how would a centralised liquidity operation work? Would it be how all the credit unions, if they have surplus cash, to pay in, or would it be a central bank, or who would the centralised liquidity business? Where would it be, or what would it be?
Yeah, there was a mechanism looked at, and indeed there was even heads of drawn up at the time back in 2009, where the facility would have been managed by the central bank. So there's different ways it can be done. I think the essential thing is that going forward, you know, as has been mentioned, the priority is trying to provide more credit facilities out to people. If for some reason then there was a short-term demand, you know, you need some mechanism in the background to support short-term liquidity requirements. As I said, it's certainly not an issue at the moment. It's quite the opposite. There's an abundance of liquidity at present. But as I said, we're trying to future-proof it, and that's why it was noted in the report.
Interest rates were never lower, but why would the credit union be looking for the change in legislation where it restricts the credit union at the moment to 1% interest rate, where they want to raise it to go from 1 to 2% to be able to charge 2% a month? It's a huge, it's 100% increase at a time when interest rates were historically never lower.
I think if you look at the recommendation from Cork to increase from 1% to 2%, which was their original recommendation in mid-2016, there's probably a few reasons for it, and really the first one is just flexibility. So it just gives flexibility to credit union boards, a little bit more flexibility to decide on their rates. It certainly isn't saying you should increase rates, certainly isn't saying you should have target rates which are double that. And I think the credit union representatives here today will probably give you some experience on the ground of what credit unions are charging. Credit unions are the only part of the financial sector at the moment which is capped in charging interest rates. So even in increasing it from 1% to 2% per month, you're still saying that credit unions will be the only part of the financial system which are capped in terms of the interest rates they can charge to borrowers. So their competitors in unsecured lending don't have any equivalent cap. One of the reasons might be that the cost of giving out small loans sometimes are riskier, and sometimes the administrative burden for that small loan being paid back very quickly, it doesn't generate a lot of interest if you're capped at 1%. As we've discussed with Senator Conway Walsh, you're looking at potentially assisting in bridging the gap between in the moneylender space as well. So credit unions being able to have a little bit more flexibility might be able to assist in the money lending space. And I suppose lastly, it just gives flexibility to do other products. So if credit unions developed or rolled out current accounts and debit cards this year, as we expect them to do, or a decent proportion of them this year, if they introduced a credit card as part of that offering to their members, they would be capped at the moment at 1% per month, whereas a competitor credit card would be, I don't know what it would be certainly above that 12% per annum from one of the competitors. So you're effectively restricting credit unions from providing some services which they might want to provide in the future. In that paper, the Cook paper in 2016, some of the reasons given for not increasing the rate were coming from a credit union survey said, look, this isn't an issue for us. You know, we don't want to charge more than 8% on a personal unsecured loan. So the 1% per month doesn't matter to us. So therefore, why change it? We're not affected by it. Some people came back and said it's a credit union ethos to charge lower rates, and I think you can still do that while still giving the flexibility to change the rate. And credit unions can still charge fair rates to their customers even if you changed the maximum cap. And I suppose thirdly, some credit unions were saying it protects members from excessive charges. And while that's true, it might also restrict some potential members from accessing credit. So you need to balance some of these. So I don't know, Ed, Kevin, do you want to just comment a little bit on
the survey that the Ministers' Committee, the QAC, the Credit Union Advisory Committee, carried out, and by number, I think slightly less than half the credit unions said they'd like this flexibility. By members and assets, slightly more than half. So I think it's coming through then, the Minister is comfortable to bring it forward then on the basis that it gives flexibility to some credit unions, as we said earlier, who are losing substantial money on this small piece of their business. It gives them the flexibility to not be subsidising it on the microcredit loans, or maybe to come into that and try and get more credit unions to formally, I suppose, come on board with that money lending project, as it were. So it's not that the credit unions went looking for it per se. They were kind of asked, would you like this option? And it's not conclusive, it's kind of half and half, but I think on the basis that they're going to be offered it, it's not making them go there. They can still charge the 1% or less if they wish. They can charge a little bit more if they wish, but with interest rates at the moment, it's certainly only in conversation about a very small piece of their lending. Who knows where they go with debit or credit cards, as Brian says.
So what you're saying is there's two areas mainly. One is the credit card or debit cards that you might be rolling out, that it could impact on that area, or on small loans that's paid back quickly, that you need flexibility to be able to increase the rate there to cover the cost of a small loan. So the small loans could be, that are being paid back quickly, could be more expensive. Is that
there's
really,
those small
loans,
as Mr. Molan, that they're expensive to administer. There's 25-cent per transaction deduction straight away from the on-post, although it is a good facility that you have the deduction at source. So those loans are very expensive to administer because they are only for €500 on average. There's a lot of transactions, there's a lot of work, and at the 12%, they wouldn't be breaking even, as it were. The competitors are charging up to 200% and 300%. We're not going anywhere near there. Even if we were to go to the full 2%, that's 24% against the 200% and 300%. So I think credit unions would see it as a way of recouping some more costs on it. The debit credit card is more a future. Who knows where rates would go longer term, even in the short term. It's probably unlikely you'd see an overdraft of more than 12%, but who knows? Rates were never as low before, and at some stage will go up. Although every year it seems to be next year. So it's within a very small context. I think people would have answered that survey, and as I say, we're all trying to encourage more and more credit unions to formally, although as Kevin says, lots of credit unions are doing it without saying that they're doing the microcredit scheme, but it's more to give some more encouragement that line of business would, I suppose, lose less money than it has been heretofore. It'll never make much money, but we do try and keep each thing break even itself, like without one overly subsidising another. But I mean, it's not for the mainstream lending, and anyway, even if it was, who would borrow a car loan at 20%? It's not going to be even thought of, because it's not where rates are. I mean, we have to be competitive with our rates, and most credit unions are charging not much more than half of 12% on your £5,000, £6,000, £7,000, £8,000 loans, or euro loans.
I think if I could, Chair, if I could just add to that, I genuinely think it's great that you've raised that, Senator, because I think there has been an unfortunate alignment of the recommendation that CUAC made about increasing the cap and the microcredit loans. It's that, when you read the report, that's not there. I mean, that link is not there. So it wasn't done for that purpose alone. It was really done, as Brian mentioned. The reason the recommendation, and the reason that we as a group then were supporting that recommendation, was because it puts the boards of the credit unions in control. And if you go back to the Credit Union Act that sets out the objectives of the credit union, I mean, Section 6.2b says to charge a fair and reasonable rate. And if it means that by recouping some of the administration costs that we could actually even open up more credit facilities to more people. That's the context. And then obviously there's the wider prudential management of the credit union where, who knows, as Ed was mentioning, where you could have interest rate shocks or whatever that we saw in the 90s. It's really just to provide the flexibility for the boards to have control over it. I mean, at the moment we have a cap that's there, and as Brian said, the only lenders to have such a thing. But it's not a target. At the moment, the average rate is only 2/3 of that limit. So it's not suggesting that rates are going to increase. So that's why it's great to get the opportunity to clarify that. It really was just to provide flexibility to the boards of each credit union that they could manage the situation as they saw appropriate.
Just on the whole area of PCP, you know,
Yes.
a lot of car dealerships are operating with PCP. The credit union have their own operation where they charge a percentage. The PCP in some places it would seem that there are problems, or that there could be envisaged that there will be problems down the road where the car may not realise how much is owed on it at the finish. How does the credit union compare to these programs that's put in place by dealerships? And some of them are charging 0% interest, more of them are charging 3-4%, 1.5% in some cases, I think. So the credit union is 7 or 8%. Or, is there a competition between dealerships and credit unions, or does the credit union facilitate dealerships as well?
I might just answer a slight, just from a Department of Finance perspective in relation to PCP, and then the representative bodies can talk about their experience of it. But there has been 2 reports. There's been a report on PCP from the Competition and Consumer Protection Commission, and following that report, the Minister for Finance commissioned a review of the PCP market. Yeah.
Sorry, Deputy.
Sorry, that review was completed in November last year and set out a number of recommendations. A different division in the Department of Finance is liaising with the Central Bank Attorney General's Office and the CCPC and other relevant bodies to implement those reports' conclusions. So that's the backdrop, I suppose, to the regulatory work that's ongoing in relation to PCP, and then the representatives might talk about the experience on the ground.
If I just could make a few points there. First of all, the whole area of PCP versus personal lending is not like with like comparison, in that in a credit union, if you go in and you actually get your loan and you go out and you pay for your car, the car is yours. You've got your value there and then. Whereas PCP is a completely different type of an arrangement. There is a fundamental area that needs to be addressed in all of this, and again, one needs to go back to the whole area of consumer protection, and to go back to the whole area that there's an actual conflict of interest here between having, like, we are providers of financial services. We are regulated, and we are very carefully and very rigorously regulated in the interests of the consumer. If you go into a forecourt, you are going to get sold a car, which is something that, we don't sell cars. It's not our area. But you will also be sold credit. And a revisit needs to be looked at, the regulation of that provision of source of credit in terms of the whole area of, that one has to lend responsibly and those particular areas. So there is further work to be done in that particular area of work. And I would say that if you look out there, and if you look at, for instance, credit union rates in the whole area of car lending and such like that, and you do take into account this difference between what you own and when you acquire an asset. And you look at things like, for instance, the deposit you have to pay. You look at the restrictions in respect of you have to get full value, you have to drive exactly the amount that you said you would drive in the first place, because if you go above or below, you're actually getting much less value for your investment of time, of money. And at the end of the day, it's not your property. So in those particular cases, there is a serious amount of work, again, from the consumer protection perspective that has to be undertaken. And if you go around and you look at kind of some credit union headline rates at the minute, the current 12% cap is just a very distant memory, you know, in terms of value that's to be had out there.
You think the Consumer Protection Agency are turning a blind eye to some of this?
Just comment on that. There was a report published by the central bank on the whole area of PCPs, and hopefully they will take it in more under their own regulatory framework. I would add to that as well, by the way, that it's not just the PCPs. There's also very easy access to in-store credit, which is another area of concern that we would have. I mean, we genuinely don't have a level playing field. And a lot of this comes back to, on the one hand, ensuring that there's appropriate regulation for all lenders to ensure the protection of the consumer. And then the other side of it is similar to what we were talking about earlier, is ensuring that the messages are getting out to the general public, that they understand. While and it's very difficult when it's made very, very easy for some of these people to provide credit, whereas, for example, in the credit union, there's certain processes that you just have to follow. And you know, obviously all done in under the auspices of protecting the consumer and making sure the consumer has the relevant information. But that's not, we don't have a level playing field. So it is something that we would ask the regulators to broaden their reach and look at all of these providers of credit. So that the PCPs that has started, we'd like to see it going further to include all providers of credit, so that, and then people can start to see like for like and see the true value that they can get from their credit union.
Right, Senator. Mr. Chairman. Senator O'Donnell.
Thanks very much, Chairman. You'll forgive me, the committee. I feel there's a lot of déjà vu around the credit unions. We've had the credit union sector in before us, I don't know how many times. And for me, as someone who looks at it on a practical level, I would have liked to have seen a lot more progress. And I was just looking back on I'm a huge believer in the credit union movement. And people, I know virtually everyone on the panel, and they have a vital role to play. There's a huge area of confusion with the general public around your lending limits and what you can do, what you cannot do. I think it needs to be more streamlined. And I suppose I wanted to go through a couple of things. I've looked at your recommendations, and just under a few headings: the structure of the credit union movement, the role, lending products it offers, the lending limits, interest rates, regulation. And I suppose a couple of points I wanted to deal with. Number one, you didn't consider in any way the issue of maybe the credit union movement being expanded into taking up a role in terms of the provision of a public banking model. We were in Germany quite recently. I would have spoken to people on it. We were on a delegation to Sparkassen. A lot of what Sparkassen did was good. I don't believe the model itself, for me, the overall model itself would work in Ireland. However, there are large elements of what they do that I liked. I liked the fact that they were a public banking model. I liked the fact that they provided competition to the prime, I suppose, the normal pillar banks. I liked the fact that they were local. I liked the fact that they charged a low interest rate. I liked the fact it was transparent, and I would have thought that the credit union as a movement and has branches at this stage, they're the only financial institution outside of the post office that have branches in virtually, or individual credit union in virtually every parish in Ireland. And that you would have a process whereby credit unions would remain individual, like the Sparkassen are in Germany, but they would be able to offer a range of products. And the question I suppose I'm asking through you, Mr. Carr, was the reason why it wasn't considered in some way to use the credit union movement as a conduit to be able to provide a public banking model in Ireland?
Yeah. Can I answer the first part of your comment first? In relation to progress amongst credit union movement, I think one of the things we tried to do in the final report was to bring out some of the collaborative efforts which are underway, which, to be honest, there's an awful lot more happening than there has been.
We'll cut to the chase, really, okay?
Yep. But
the credit union movement should be, from the public perspective, I know there's some credit unions doing mortgages, right? I think they should be in the small mortgage area, providing competition. Yeah. I know it went through a very, very great difficulty in terms of restructuring, right? Yet when you look at their metrics on page 14 of the report, right? Loans have gone up by a very small amount, right? Your loan to asset ratio is 27%. There's no reason it shouldn't be double. It shouldn't be 40% plus. The arrears appear to be within a reasonable area. And the question I suppose I'm asking is, why have loans gone up so little? Okay. Why is that the case? Why is there not more lending happening by the credit union movement? And we continually over the years have got the credit union movement telling us that the restrictions on lending are too severe, right? Why have those changes not been made? We've gone from the credit union movement down from 264 credit unions, it was 343 in 2015, and no doubt it was much higher than that originally. It was down from 400 in 2013. So I would like to see, for me, the credit union movement, and it's cut both ways, I'd like to see the credit union movement proactively looking to put a public banking model in place.
Yeah, and I think if I simply answer your question about why wasn't local public banking dealt with in this report, it wasn't part of the terms of reference. That's a simple answer. But there was a report issued by the Department of Finance last year in relation to local public banking. There was a terms of reference drawn up after that report, which is to do an independent evaluation of how you could deliver local public banking. I think the main recommendation from the original report was the state wouldn't invest, but it was that local public banking is a good thing, it should be advanced. As part of that terms of reference for the independent evaluation, credit unions are referenced as one of the delivery mechanisms for local public banking. I would agree with most of the reasons and rationale you stated in terms of why. So
it
that's
would require no state investment.
Absolutely.
It's for me, looking at it, right, and we spent 3 or 4 days intensively in Germany looking at the Sparkassen model, right, and we spent going through it. And for me, the Sparkassen model, as it looks, setting up and doesn't, we already have a network. Yeah. We have a very viable network. We have. So the question is I would like to see, and by doing that, it would give a framework that would enable all these other areas to come in. So what I suppose I want to know is, why has the increase in lending been so low, and why is the loan-to-asset ratio in terms of lending by credit unions movements on the low side? What has caused that?
Yeah, can I just finish on one comment in relation to local public banking? So if you look at what local public banking does and what Sparkassen does, and you've seen them in Germany, if credit unions, and if a decent proportion of credit unions bring in current accounts and debit cards this year, what will be the major gap that's left the credit unions aren't providing? It will be small SME lending on a bigger scale.
And mortgages in a more structured
mortgages
way.
are underway. The guys have set up processes. I consider that's an implementation phase at the moment. But SME is the last remaining area which would be required to effectively deliver that local public bank. So I certainly see that as being achievable. It needs skills, it needs investment. Credit unions individually can't do it.
Well, then the Canadian model, is there, which is effectively setting up, and that will require cooperation within the credit union movement, where you put an area of expertise. I mean, let's say a back office. There has to be Chinese walls, because I think credit unions themselves are entitled to confidentiality in terms of dealing with their own individual customers. But, and I know I'm slightly diverting, but the microfinance project that's there at the moment, are the credit unions losing money in that, the way it's structured at the minute? Can you explain why?
Good.
Yeah.
I'm sorry, there was the lending growth question, which I'm sure.
Well, they're all interlinked. They're all interlinked.
I'll take Mr. Johnson, Mr. Moore, and then Mr. Carr maybe again.
Really, the base of my question is, why is lending growth being so low? Are you losing money on the SME microfinance? What restrictions, what's causing that? And obviously I'm needing that into the restrictions on lending. And just give your overall perspective on mortgages, the whole thing on the current accounts, the debit cards. I just feel there's a glorious opportunity here for the credit union movement to fill that gap, retaining their individual identities as credit unions. It will require no state investment. It will be at a local level. It will provide competition to the pillar banks that they need. There is a degree of arrogance creeping in again. And so you might just deal with that. I know I'm going very general, but I really don't want to get down into it. I want to know what's happening.
Mr. Johnson.
Yeah. No, thank you, Senator. And I know there's a huge amount in that, what seems like a simple question, but there is a huge amount in it. And maybe trying to stay at that high level, there's probably 2 or 3 areas that really capture the essence of what you're talking about. And if we break it down between one, access of the public to the services, and the second then would be around the lending itself. So while the lending has grown, when you look at the loan to asset ratio, it hasn't improved because
it has actually gone down.
Well, it's improved slightly. It's gone 27 to 28%. But that being said, you know, that actually is a reflection of the level of trust that people have, because they're putting more and more of their savings into the credit union. So look at it.
That would not account. I mean, well, the savings have gone up by 1.85 million since 15. That wouldn't account for everything.
No, not everything. No. But what I'm trying to say is that we're trying to cater for and look after everybody's, both their savings and their credit needs. Now, on the credit side, in Mr. Corr's opening statement, it referenced the 3 different papers that the group submitted to the central bank, and the primary and the high priority was the lending, and that then led to the issue of consultation paper from the central bank, which has just closed. And in that consultation paper, they did take on some of the recommendations, and it's great to see, for example, the basis of the limits moving away from percentage of loan book to a percentage of assets. So that's hopeful. There's potential there. However, when you put it into the context of being able to provide a broader public banking style model, we would have some concerns, and we've raised these, and Chairman, we'd be very happy to send you a copy for the committee of the submission we've made and the concerns that we've raised, because when you start putting caps on unsecured loan terms, when you start restricting the ability to loan for buy-to-lets for second homes, and there's even around the point you were raising around the small businesses, the definition is now going to be owner-managed only. There's also a grouping proposed of bringing the that SME lending in with the home loan lending and having one limit around that, which is difficult to understand. So I think, and hopefully the Central Bank in their considerations of the submissions will review some of those. I mean, that's the purpose of the consultation.
As it currently stands, Mr. Johnson, right? What's restricting you from growing lending at the moment? And are you making money on the microfinance?
Well, on the personal microfinance, no. There is no money being made there.
Why not?
Because they're short-term loans. I mean, if you take, for example, I'm trying to think the figures off the top of my head, but if you take a €500 loan over a year, the credit union would make roughly €35. So when you consider, as Mr.
You'd be charging what rate of interest? 12%?
That's charging that rate, yes.
So with
and not all charge that rate, by the way. So that is definitely.
What rate of interest do you need to be charging in a loan to cover your overheads and make a profit in a? See, the problem is we're talking about raising the limits from 12% to 24%, right? If you go 1 to 2%. The question I'm asking
well,
is...
just to be very clear, Senator, we're talking about giving the boards the flexibility. We're not talking about raising interest rates.
But if you're charging 12% at the moment, right, how is the credit union losing money on charging 12%?
Because the cost of putting that loan and administering that loan is more than €35.
So what's, on average, what percent does the bank need? The credit union, it's basic stuff, right? It's all very well saying you're making a loss. There has to be a reason why, and I'd like to know what rate of interest does a credit union need to be charging to cover their overheads? And the question then you have to ask is the cost base of the credit union moving too high? So I have to ask the question. So, the problem is I'm here a long time. The credit unions have been coming into us on average since 2007. That's over, at this stage, nearly 12 years ago. We were discussing the same issues 12 years ago. So the question, and I know there's restructuring is taking place, I need to understand what can be done with the credit union movement in terms of a structured basis, because I passionately believe in what they do. So the question I'm asking is, what rate of interest should you be getting on the micro to make a return?
With due respect, Senator, that's the start of your question and then narrowing it down are not really the issue. I mean, the first, if I could address the first part, which is what needs to be done. And as I said, there's two big parts of it. One is the lending that you're allowed to do. Does that permit and set out a roadmap to see credit unions evolve to the public banking type model? We would be concerned that the proposed limits do not do that. Okay. The second part is really around the whole area of access. So if we're talking about a public model, well then all of the public need to be able to access all of the services. And that is a challenge for us, and it's enshrined in legislation at the moment how that works. But we have to find mechanisms that will either allow credit unions to introduce business to each other or to share the risk, the loan participation, things like that. And that's the type of thing that you'll see in North America, for example, loan participation. So a smaller credit union may only put 10% of that risk on their balance sheet, and another credit union may carry the rest. There's other ways, but they're the type of things we have to look at. At the moment, the credit union has been very, very successful in managing its own local business. But now what you're talking about is how do you bring a wider range of services, and inherent in that is a wider range of risk. How do you bring that without jeopardising the credit unions? And it's to find mechanisms that they can share the managing and handling of those risks on their balance sheet. Because even the type of thing that you mentioned around some shared services, that still doesn't address, that helps with the efficiency of delivering the service, but it doesn't address the management of the risk, because it still has to reside on someone's balance sheet, and that's as it's currently structured.
With your respect, I don't want to go on. I have a different interpretation of public banking. My interpretation is that if you have a small credit union, they don't necessarily have to provide all the services. If there's a bigger credit union up the road, they can do it.
Sorry, but that's exactly my point. Sorry,
the point I'm trying to make is that.
So, but then in that case, then we have to go back.
The small credit union doesn't have to take on the big loan and share the risk with the bigger one.
That's what I'm trying to say. That the smaller credit union, there has to be a mechanism to permit them to introduce their members to the other credit union that can manage that risk. At the moment, the way it's structured, it doesn't facilitate that. So we're actually saying the same point, actually.
Mr. Farrell, obviously, large number of credit unions. Can you tell me what's restricting the growth in lending under the current rules?
Well, I mean, it goes back to some of the stuff earlier. Obviously, as we would see, the lack of a level playing pitch, the PCPs and the in-store credit, so all these other entities which don't have the same regulation and the same consumer protections are able to drive loans or credit out. We have a far different regime, so that's not helping the interest rate cycle. The last 10 years, the recession, people were paying down their debts, not clearing their debts.
Okay.
So now we're back where the country, subject to Brexit, but the country is doing well. Our loans are up, our savings are up more because all the local branches of the banks have closed. So people are taking out their money, thinking they're supporting us by lodging the money, and really it's a headache, or it's a social service the credit unions are doing, minding the people's money. They're not making a return. So we're all then, as everyone has said, increasing the capability of credit unions, whether it's in the current account, in the mortgage space, or in the SME space. The mortgage space, as Brian Corra said, it's complex enough. So we have our own back offices. The two entities have back offices helping credit unions do more of the mortgages, and then we have to convince the central bank to widen the limits to do more of them. And we have shown that credit unions can and will do mortgages. It's the same then with the SME lending, and I think we're probably across paths. When we say the microcredit, we're talking about the €500 social welfare loan. That's where we're losing money at 12%. The competitors are charging 200% and 300%. When you talk microcredit, you're probably talking small SMEs, and credit unions are doing that at 6% and 7% and 8%. And that's enough once they underwrite it, once they can understand the little set of accounts and projections that businessman brings in, and there's a consumer protection thing there. The credit unions now have to do a business plan with the carpenter or the plumber, and that's almost an oxymoron. They wouldn't call it a business plan, the tradesman, but that's what you have to do, and there is consumer protections, and that's only right and proper. So credit unions are doing that at 6% and 7%, but again, it's on an individual basis because each credit union is individual in law and in regulation.
Mr. Farrell, are you losing on the micro one because people are defaulting on loans? Is that the reason?
No, even as Kevin says, at the €500, the €35 interest for the year, assuming to pay off the loan, isn't covering the administration fees. But there's probably only a couple of €100 million worth of loans in that space out of the €4.5 billion. So that's not what we're majoring on here. That's only a small piece of a bigger report.
I'll finish on this. Can I just go back on the mortgages, right? What are your limits on mortgages at the moment? What can you lend in terms of home loans?
At the moment, you can lend maximum 15% of your loans in over a 10-year period. So you can do 15. So if there's 4 billion, you can do 500 or 600 million.
And you can
total on your balance sheet.
And over what period of time can you give mortgages for?
Up to 25 years. That's not necessarily the issue.
And the amount you can give in a mortgage?
There's no financial upper amount. There's no, that's not an issue. You can give.
And what has been the growth in that area for both bodies?
Oh, from practically nothing to a few $100 million, I guess, in total. Yeah.
How much?
There's 170 million.
That's in the entire credit unions?
Since the recession. I mean, there wouldn't have been mortgages 10 years ago pre-recession, hence we didn't need any bailouts or anything. So any mortgages we've done is more or less since the recession. So from a standing of 0 to a couple of $100 million and more coming. But it's still on an individual credit union basis within the appetite and all of that board. It's not as centralised. So we're helping on a back office basis, but the mortgage of that credit union in Cork or that credit union in Limerick is on the balance sheet of that credit union in Cork. It's not centralised. We would have promoted a centralised
can I just conclude?
Model, but it didn't go anywhere.
Mr. Farrell, are you open to a public banking model? And then I'd ask Mr. Moran just for his overall view.
Yeah, we conclude on that then.
Yeah.
Our view is the credit unions in Ireland are not that dissimilar. I mean, 3 million people in the Republic, there's 5 million on the island, there's 10 or 15 times that in Germany. So again, it's a bit like England, you have to divide every balance sheet by 10 or 15 to compare like with like. If the 50 credit unions who are expected to offer the current accounts by the end of the year get there, and those 50 or 100 credit unions are doing more mortgages, we're getting there, but it's still on an individual basis. There isn't, I suppose, regulator or even government buy-in to a centralised basis. So, I mean, we would have submitted a paper in 2015 on centralised SME lending to try and centralise the risk and the expertise to help credit unions do more of it, and that's not travelling, as it were. So on an individual by individual basis, it's 250 credit unions on an individual basis that adds up to the total. But there is more being done, and there will be more coming from a slow, late start, as it were.
I suppose not wishing to repeat the points made already. One of the key areas to address some of your concerns, Senator O'Donnell, is the creation of secondary markets, which is key and practical and operates in the likes of the USA and Canada, and at least within the very restricted terms of reference that we as a committee were given, one of the actual practical advances that we are putting forward there is the ability of credit unions to recommend business to other credit unions. So, you know, it still doesn't get away from the whole area that was introduced by Senator Conway Walsh earlier, in terms of the idea of having effective collective lending mechanisms, and, you know, again, those are particularly worthwhile. And I think, to echo Mr. Johnson's earlier point about consultation paper number 125 and the levels of restrictions that are being proposed in terms of those, including restrictions on lending to people who have no property going forward. I think that is an area that certainly merits careful consideration going forward.
Thank you.
Deputy Burton. Thanks, Senator.
Thank you, and it's good to see you all. I have to say, from your presentation, I get the sense that things are improving, but not terribly quickly, and it's obviously an issue I have been interested in over a long period of time. If I could perhaps maybe ask Mr. Johnson first. Not too long ago, if you recall, when the discussion was on about how you could actually provide mortgage loans to people who would traditionally be in your family customers, and you know, you'd be well placed, I think, to do some of that business. The Minister for Housing did indicate that he had created a vehicle, a statutory vehicle, which would enable mortgage lending to take place. But, and I had a lot of parliamentary questions and so on, and my understanding was that nothing that the Department of Housing did entirely met the requirements of the Central Bank, not just the requirements of the Department of Finance, but in fact the requirements of the Central Bank. Now, I do appreciate that some lending, as you've referenced, has actually, mortgage lending has taken place. But to be honest, in the context of the people who need housing, I think we might all collectively agree the amount is very small to minute. And when you look at the fact that you've got about 14 billion in terms of availability of potential loans, it's I don't know, first of all, are you disappointed with the rate? Do you think it could be higher? What would be a realistic target? And what is the problem, as it were, with the central bank requirements? Because the parliamentary replies kind of go around in circles. The Minister for Housing, the Department of Housing are very anxious to say there is this availability. They point to the recent take-up of some lending as evidence of this. But then, when you talk to the central bank, you get the sense that the central bank and the Department of Finance are extremely cautious, stroke conservative, in the context of the idea that there would be a significant, rapid expansion in terms of the demand that is there from young people who at the moment could get a mortgage which would be cheaper than the rent they're paying. You know, 20-somethings, 30-somethings. Actually, a lot of them probably working in the public service, including in the Department of Finance and the Central Bank. I think they're queuing up through the various civil service credit unions. Could you just comment on where that is at the moment?
Sure. Yep, certainly. Thank you, Deputy. Maybe if I could maybe just separate, because there's probably two very distinct areas in there. One being the social housing, and the second being mortgages directly to people. So on the first one, on the social housing, you know, we've been advocating for many years, in fact 6 years now, that credit unions should be supporting this, and this is very much not to the occupier. This would be to the provider of the social housing, primarily the approved housing bodies. So our initial preference, and it still is our preference, would be that credit unions could individually or collectively lend for those purposes. That would have necessitated an enhancement to the Credit Union Act, and in the absence of that happening, the Central Bank, to their credit, reviewed the investment regulations, and they enhanced them to allow for a facility where credit unions could invest into a fund, a regulated fund, that in turn would then lend on to Tier 3 approved housing bodies. Now, the vehicle is not, there isn't one actually active. All of the work has been done to see what it would take and all of that, but because of the reclassification of the funding for the AHBs, what has now happened is that the demand isn't necessarily there for the projects, and this is where the anomaly comes for ourselves, because if a fund was to be activated, then it incurs significant costs. And if you're not going to get the projects because all of the funding ends up on the state balance sheet, well, you've already got, you know, the HFA providing funds there, so that there isn't necessarily a motivation for the AHBs to diversify their source of funding. So our view would be that all of that is just adding to all the frustration. It's still not putting houses out there. It's still not providing for social and affordable housing. And I suppose really what we'd say is we have explored many different mechanisms. And unfortunately, 6 years on, we're still sitting here and we're still talking about it, and we're still looking at balance sheets that have funds available for such necessary causes as social and affordable housing. So just by the way, we are, we are persisting with it. We are not letting up on this, and we are open to any opportunities that may arise to facilitate or to work with it. And in fairness, we have worked with the housing department. We've worked with the AHBs themselves. But it may still come back to maybe we would be better off just having the facility to lend direct and broaden it beyond just the Tier 3. It also would take away perhaps the necessity to have to reach projects of certain sizes to make it economically viable. So that's one side of it. The other side then that you mentioned is more to do with providing mortgages directly to the borrower, the occupiers of the owners of the properties, and that has, as we've been saying, there's facilities put in place now to support credit unions getting there. The proposals by the central bank for the revision of the basis of the lending limits will certainly help. Moving from a percentage of a loan book to a percentage of assets it really is a very welcomed move. We have reservations around how credit unions can actually access the higher level of 15% of their assets. And the only reason we have reservations is because it's not transparent, we're not clear what it is. So hopefully that will be clarified in the feedback statements at the end of the consultation period. I don't know if any of the others want to add to.
Could I just ask Mr. Farrell first, if he could just indicate how it is for the League?
Yeah, well, it's the same. It's the same lending rules, obviously, for every credit union. So we're pleased that the consultation, the review of the rules for the long-term lending is out there. Well, the closing date was aired in the new year. We're obviously not necessarily happy with every suggestion, and we've all put in submissions. I think I read there was about 50 submissions put into the bank. So there's light at the end of the tunnel, I suppose, not every detail, that there will be more facilities or more headroom for individual credit unions to do more mortgages. So that's people, I suppose, in reasonable jobs buying their houses. And the social housing, it's as Kevin has outlined, I mean, we've half of the equation. We have the rules got changed by the bank to allow credit unions, and again, maybe slightly restricted, but at least the concept there via the fund into the tier 3, and I suppose maybe it was like a pilot, and if that was happening and happening well, the tier 3 would be broadened, and the opportunities would be broadened. The disappointing thing is that the vehicle doesn't seem to be there. It's been hard enough even to get to the point of figuring out, is the vehicle there? We were told it would be ready last September, earlier last year, and then that vehicle was a different vehicle, and now we're not sure if that vehicle is there at all, even in a different status that we could then maybe complement it or bolt on a regulated piece. So that's been the frustrating piece, that it's been just hard to figure out where the social housing structure is in development. And as I say, we thought we were there a year ago, and we're not there now.
Can I just follow up on that? I mean, at the moment, as you know, and this is relating to the second type of lending, there is, if you like, a scheme out there where an individual on an income of 50 or a couple 75, now the limits are low enough, but they're applying to county councils. And that process is very slow. On the other hand, we have the first trickle-throughs of people getting those loans. I mean, are the credit unions involved to any degree in that kind of lending? Because I'm talking specifically about affordable housing. Somebody buying either a new or a second-hand house, very often, certainly in the Dublin region, a second-hand house quite far out, which might be available around 300,000. So if they have got together the deposit on that, they're talking about being able to borrow 240, 260, somewhat lower in rural Ireland. But again, the numbers, I just think there could be a role there for the credit union to be able to make an offer, but is that also restricted? I mean, with the AHBs, I think they've better offerings available elsewhere rather than going through yourselves, if you don't mind me saying so.
No, with the mortgages, any earning individual is entitled, if they're a member of their local credit union, to approach the credit union and see what they have on their mortgage offering. And if it's the same rules, so it's the same macro-prudential, the 3.5 times earnings and the 80% if you're a first time, or 90%, or around 90%, you can borrow up to 90 if you're first time buyer. So it's the same rules, but at the same time we've seen the average mortgage at around 100,000. So we haven't seen the average mortgage at the 240, 250 coming through yet. So credit unions have only an amount of space, so they're probably going to do more of the smaller ones, and that mitigates risk as well, than doing lesser of bigger ones. But there is, in theory, no barrier there.
I think on that as well, it's been very encouraging to see that credit unions haven't dived into the high risk end of the market. Again, similar to what Mr. Farrell has said there, like, we've seen an average, the average loan is about 110,000, the average loan to value is about 56%. And part of what you see is like some of the good schemes, like the tenant purchase schemes, like those being facilitated. And as the credit unions building up the confidence and the competence in doing it, then they can start serving more. So, but we have seen some of what you've mentioned, but not in a wide scale. But just on your point about the AHBs and credit unions supporting them, I'd respectfully disagree. I think there's a great opportunity for the credit unions, and we wouldn't see it. And the reason I say that is because we would see it as an also, not instead of things that they have. It should be an opportunity for them to even be more ambitious in providing even more units, because, as you well know, there's such a scarcity. I think every source of assistance, and it's just so in keeping with the ethos of the credit unions. It is a perfect fit, really.
And can I ask you if, do you know, can you identify, maybe to assist the committee, things that could happen that would make this easier, but also that whether couples or groups that have come together, maybe in it, say like the O'Coulon group, in a modern AHB, are there things that we could help to facilitate that would make that easier, and that would perhaps persuade both housing and finance that this might be something positive?
Yeah, and I think, to be fair, we have to be able to. I think the AHBs themselves have some really ambitious plans and objectives, and I think if we can actually work with them to help address that whole reclassification issue, then that I think is because the concern that obviously we would all have is that if all of their funding is regarded as on balance sheet, now they're going to find themselves competing with every other infrastructural project that the state is looking at, which can only mean that overall it could impose an unnecessary and unwanted limit on what they can do. So we certainly would love to work closer with them to see how we could help getting that reclassification back where they're off balance sheet.
Just one or two comments in relation to credit unions can invest in tier 3 approved housing bodies at the moment, and obviously it's within the gift of the central bank if they wanted to review whether it's only tier 3 approved housing bodies that credit unions can invest in. So that's a matter for the central bank. In terms of lending to approved housing bodies or other providers of finance, it is much more of a legislative issue tied to common bond. So at the moment, a credit union can only lend to a member who is broadly within their common bond. So there's a legislative issue as well as a regulatory issue in terms of expanding some of that.
So which department then would you choose? You know, what would your advice be as to which is the relevant department to progress this piece of legislation? Is it the housing department, because they're kind of indicating they already have this on the books, or is it either the Department of Finance, or is it amendments in terms of central bank?
If credit unions and obviously subject to Cabinet and Oireachtas, if it was a change to the Credit Union Act, it would be Department of Finance, so it'll be within our team. If that's what you wanted to revisit the kind of the legislation in relation to the common bond.
And just one final issue on the housing one, in terms of the 14 billion that is, if you like, the stock of funds of savings that the credit union movement has, roughly what proportion do you think could actually be invested into, you know, mortgages, whether of 10 or 15 or 20 years, or to approved housing bodies? Like, is there a target being set by the group as to what you might like to realise, say, if the legislative structure was got right, that could be done, say, within the next 3 years?
No, what I'd probably say under under the investment into approved housing bodies, there's capacity to do around 700 million in the regulations at the moment. I'll have to come back to you in relation to what's in the new consultation in relation to mortgages. About 800 million, I think, in mortgage capacity in the current version of the consultation paper. We'll just touch, just to close off, one other aspect of the implementation group's report. When we made recommendations to the central bank in relation to long-term lending, we recommended that they review the 25-year limit on the mortgages. So credit unions have a 25-year limit in regulations. As Ed and Kevin have said, credit unions are at the moment doing much lower loan-to-value lending and much shorter maturity lending. But notwithstanding that, we felt that reviewing the 25-year limit was appropriate. The central bank didn't do that. The reason we thought it was appropriate was because no other provider in the market is tied to the 25 years. And if you look at the statistics for the first-time buyer lending, a good proportion are beyond 25 years. So the lending you mentioned to, say, civil servants who wanted to get a 26-year loan, they couldn't go to their credit union. So that it was for those reasons. I appreciate the credit unions are focused much more at a different niche of mortgage lending for the present, but just in terms of, I think Kevin used the word earlier, future-proofing. I think that was something we, as a group, thought would be worth recommending.
Okay. There's one other brief question I have, which actually you partly commented on, and it's been quite helpful to comment. As Minister, I was involved with the development of the very small, the micro loans, the Make Sense loans, and I think one of the issues, and you've partly answered it, but one of the issues that affects people who are on a social welfare income, the loan is potentially very popular. It was piloted with members like the Finglas Credit Union, and the demand for it has been very good. But relatively few credit unions are doing it. What occurred to me was and I accept that for reasons of credit unions being small-scale structures, I can appreciate admin costs and handling charges are probably very high. I mean, like, would there be scope simply to suggest that each loan could actually generate a fee, for instance, from the Department of, Social Protection maybe? Because really it is such a vital area that when people get back on their feet, perhaps after job losses, maybe, all sorts of financial difficulties, or maybe they've never been involved in any kind of structured borrowing. It's just been the people from the finance company who knock on the door and provide them with a loan. And it just so fit with the historical ethos of the credit union that I would be really anxious to just see this develop, because I do know in areas, I actually know in areas of my own constituency where people are aware of the credit unions that are offering, they can go to it. It's working very well. This is a model, by the way, when I worked in development, I was involved in helping to develop in places like Ethiopia. So, it really does work. So, if you had advice again as to, for what I think would be a relatively small cost, if there was to be some kind of, originally, I recall the problem with the Department of Finance and the, I think, 4.5 years of discussion I had before we got a successful outcome, but we won't go into that. The problem, that was there was obviously that this was going to be time-consuming. People involved might need a lot of support, and encouragement to become regulars. MABs often got involved and were the introducers to the local credit union where the service was available, where they were helping people maybe resolve debt issues. But compared, say, to a commercial bank, what are your charges like for somebody who has an account with the credit union? And indeed, if the Department of Social Protection is in effect sponsoring a small microloan account, would something like a 30 euro charge on each loan, you know, because it would be a relatively small payment that could generate possibly an expansion of the scheme to most credit unions in the country if it became viable. I don't know, is that realistic?
Yeah, can I just make a general comment? So myself, Ed, Kevin and Department of Social Protection and my colleagues in consumer side of Department of Finance and a few others, including the Central Bank, sit on a group which is chaired by MABS in relation to the PMC. And what we are doing is looking at all of the different potential reasons why there might be slower take-up by credit unions, and we're seeing, are there different options that we can advance within our own respective remits, which would help that. So there has been a lot of work. This has been going on for quite a while. There's some interesting ideas coming out of that, but I wouldn't say it's just one idea. We're looking at all of the different reasons why it mightn't be taken up and seeing if there's things that we can do to make it better.
Okay, thank you.
Right. Sorry, Mr. Morgan.
And Sir, Deputy Burton's question there a bit more specifically as well. The point I raised earlier about the charge of 25 cents by Unpost, that's 13 euro over a 12-month period. And
they wouldn't take up the scheme without that.
Well, like you have to pay that. Somebody has to pay that, and that has to be actually paid by the individual themselves. So it's actually taken out of them. Then there are other kind of charges, such as that will come in through electronic fund transfer. That doesn't come for free either. So like there are a lot of other kind of charges as well that are there before you even come to the whole question of, you know, kind of the 35 euro return. So there's practical things that could be
Yeah,
looked at.
I appreciate that this is a small area in terms of the totality of your operations, but socially, in terms of helping people move out often of very debt-ridden situations, and the alternative being the commercial money lenders. If you want, I might say to the Chair, if the committee wanted to maybe come back to us with maybe summary of some of the possibilities and recommendations, I personally, for one, would be very open to, some recognition being given of that. I can't really see that social protection would terribly object. They mightn't like paying any money to anybody, but it has never been asked, actually. It never arose. In fairness to the credit unions, I don't recall, and it was a long conversation going on for about, up to 5 years before we got the go-ahead. And in fact, it then did prove as successful, thanks to the credit unions who participated, and was really transforming in terms of people's lives who were able to get successfully into the scheme. So I congratulate the credit unions who have taken part in doing that.
And to that point, Deputy Burton, there are credit unions out there, and this is as much about self-enablement. It's as much about development of people. It's not just about forking out money. It's also about kind of education and stuff like that. And there are credit unions out there who are actively involved. And this is where, again, a lot of the real costs of this, if you get serious about it, you have to kind of see it as more than just a handing over of money. And there is a piece of work there that I think that realistically, a bit of help and a bit of assistance along the way from the department might make a difference.
Thank you, Mr. Rowland. Could I just go to your opening statement, Mr. Carr? Yeah. You say that you submitted a final report. 3 papers were completed by the implementation group on lending engagement tiered regulation to the central bank.
Yeah.
When was that? When did that?
So
those documents, when were they submitted?
They were submitted roughly the same time that you would have got them here as a committee. Lending and engagement went in late 2017. So they were
2017.
Late 2017. So they were effectively the first tranche of work. And then the tiered regulation paper effectively was finished at the same time as the final report. So we sent it separately to the Central Bank, but we didn't send it separately to the committee because it was effectively in the final report
So
anyway.
2017?
Yeah, end of 2017.
Right. Again, in your opening remarks, I don't know why this happened, but as you were speaking, you left out part of your speaking note.
Yeah, I was trying to speed it up, it was too long.
Well, no, I thought it was an important part, actually, because it points out that the documents do not bind the Department of Finance, the Central Bank, or any other members of the implementation group in advance of any public consultation carried out by the Central Bank in accordance with a statutory mandate or any legislative process commenced by government.
Yep.
So essentially, you're acknowledging in that that there isn't, it's simply your opinion and they can take it or leave it.
Collectively as a group, so it's,
They can take it or leave it.
it's a committee, yes.
They can take it or leave it.
Yeah.
And then, in another section of your contribution, you said that, you didn't say, again, and we must remember that the Credit Union Act 1997, as revised, prescribes in many cases the Central Bank ensures that its regulations are effective and appropriate, having regard to the nature, scale and complexity of credit unions, or the category or categories of credit unions to which the regulations will apply. I think these are important pieces, and I'll tell you in a second why. The other part left out was when you mentioned about wide potential expansion of the provision of mortgages and the further rollout of agricultural lending. The piece you left out was and other SME lending initiatives. So the point I'm making is that they're all important pieces of information because they indicate that you are a committee and that they don't have to bother listening to you if they don't want to. And I want to say that as we're discussing the credit unions, I'll make Senator O'Donnell, I think it's the same story over and over and over again. And all of the interested parties at national level, outside of the credit unions, the Central Bank, the Department of Finance, I'm not being critical of you in a personal way, but I would say that they're dragging their feet on any, I suppose, opportunities that the credit unions might have to get out there and do what they want to do. If they were a normal business, I don't know what they do with the regulations that are heaped upon them. And the other, the suggested improvements, they just seem to be put on the back burner as far as the Central Bank is concerned. The reason I say that is, if you just bear with me, there's a status of CUAC recommendations, right? They're all current, aren't they? When was that report written again?
End of the year.
End of the year. So, now remember, or I remember, as we go through this, I have to continue to remind myself that the Credit Union Advisory Committee, then there's the CUAC Implementation Group, another layer of bureaucracy, and then you assist in the implementation, you advise the Minister, right? That's what you were set up for, and part of that, and the Central Bank, of course. So when you go to the recommendations then, recommendation number 1, in response, and the status is, a detailed scoping paper submitted to the Central Bank for consideration. That's what it says there. So you've done all your work, you've done your recommendations, this committee did recommendations, so the Central Bank now have to think about it. Then you go on to the lending limits. Detailed scoping paper submitted to the Central Bank, November 2017. Sorry, I should add to that the steps required formal consultation by Central Bank, which commenced on 24th of October 2018. So more consultation, more chat and so on. Then you go on to recommendation 3A, same thing again. Detailed scoping paper submitted to the Central Bank 2017. and it hasn't been introduced. You go on to the next one, 3B. This remains a matter for consideration by the central bank. You go on to 4. It remains a matter for consideration by the central bank. Question 6 then, the business model development. Well, that's been done because that's the credit union developing itself with no reliance on the central bank or the Department of Finance. So that's going to go ahead. That's grand. 7A then, the minister is to consider it. 7B, the minister is to consider it if it's necessary. So any action that was to be taken by the credit unions has been taken. But actions that require the intervention of the central bank or the Department of Finance will take forever. So I'll ask you to comment on all of that against the backdrop that digital banking has now become extremely popular. And N26 and Revolut, I think it is, are participants now in the Irish market and regulated. So they're steaming ahead, and we're in the dark age of the credit unions that I, as a member, am extremely proud of. But I think that we're being unfair to the credit union movement in the context of what they could do and what they want to do. And it's the central bank and the Department of Finance are dragging their heels. So you might comment on that.
Okay. In relation to the recommendations, the most important recommendation as a group, collectively as a group, we felt the most important recommendation was in relation to lending. So the full review of the lending limits is underway. The consultation has started. The central bank did take significant account of the scoping paper that we issued to them in late 2017 as a group in relation to that. So a fair bit of that got incorporated into the consultation. Not everything that the group recommended. But in relation to that consultation, each representative body who's represented here today and other stakeholders, all the individual credit unions, will be submitting, or a lot of them have submitted, submissions to the central bank in relation to that consultation, and they will be raising different things to what collectively we would have raised as an implementation group. So that goes to the heart of the group can't bind individual credit unions or individual rep bodies as to one form of progress. On tiered regulation, which is probably the second most important aspect of the CUAC recommendations, the tiering that was proposed by the advisory committee, the 2 tiers, effectively wasn't agreed to collectively as a group here. So we put forward a tiered regulation paper to the central bank, but in a sense we were saying that it should not be the 2-tier regulatory framework. It should be something different, which is tiering in regulations, which the central bank are currently doing at the moment, and for that to be revisited if the central bank don't deliver that. But they are delivering a portion of that at the moment. The one, and I did call out. We did call out the third recommendation. The third recommendation that the central bank did not progress, and I said it in the opening statement that as a group we were disappointed, and the advisory committee is also disappointed in, is that they didn't bring in a form of service level agreements, which was the original recommendation between credit unions and the central bank. So that is definitely called out as something else. In relation to governance, in relation to 3B, which is consultation and engagement, which is tied to regulatory impact analysis in consultation papers, the group felt that there was satisfactory progress by the central bank. Definitely room for improvement, but there was satisfactory improvement. In relation to item 4, which was governance, there wasn't any action required specifically of the implementation group. Therefore, we reviewed the issue, but there wasn't any action required. On restructuring, the Department of Finance has committed to doing a review of restructuring cases, the mergers, after a significant period of time. So say a few years of embedding those. So that'll be a review in 2020 or 2021. So that is the action being taken there. In relation to the interest rate ceiling, as you all know here, this is a legislative change, so it has to go through legislative process. I can't preempt the views of Cabinet in relation to approval for heads, but that is progressing, and that will, assuming that is all approved, will come to yourselves.
Right, well, can we hear from the credit union movement? Because what I'm hearing and what we've heard all along, in my opinion, in this is one body blaming another, or spreading the blame, as it were, for the poor delivery on the recommendations either by this committee or indeed by CUAC. And like Senator O'Donnell, can you tell us, in the face of all of the business model changes that are taking place in banking, digital banking, where are you going to be when that completely runs you over? And you've answered, Mr. Carr, for the Department of Finance, if you like, and you've given us a view on the central bank and some of the issues. What has the credit union movement to say about that? Because your members are getting frustrated as well.
Yeah, I suppose if you step back, Chairman, to your opening sort of observation, I mean, in the summer of 2015, the then Minister proposed to take all the 95% of the rule setting away from the Minister and the Oireachtas and the Department and move it to the bank, and we all I suppose fought that at the time. Unsuccessfully. These reviews came out of that. So since January 16, 95% of all the rules around credit unions are set by the central bank and then policed by the central bank. So they set the regulations, they set the rules, and then they police them. So that's how or why most of the stuff in these reports then are recommendations or opinions. It's the ultimate discretion or not of the regulator to act upon, not to act upon quickly or not to act upon quickly. If you go
Mr.
back.
Carr, in some of his remarks there, he said that the credit union movement couldn't agree on certain things.
I think that was in the peer regulation where it came back from an earlier committee, the Commission, so back in 2012.
Is it the fact that you can't agree? Is that
well, what was agreed to in the end was a different version of tiered regulation. It was the tiering within each one. So I think it was a good.
So you have agreed to it?
Yeah, a different tiering 8 years later because time had moved on. I don't think he was saying the disagreement led to the delay.
I'm not trying to catch anyone out, Mr. Farrell. I just want to establish where this is all at, because the committee here has gone over and over the arguments. And I believe that we gave fair time out of our interest for credit unions. And we wanted to see some progress. But in these reports, it's just telling us, and I know, Mr. Carr, you say, there's progress being made here. In their report, which I'm reading in front of us, it refers an awful lot to further consideration by the central bank. When, in the name of God, are going to make up their minds? Will the credit unions be out of business? Will the digital banking have taken over by the time you get to the point of actually opening up the doors fully for business? So who is going to answer that question? Mr. Johnson.
Chair, what I'd say is, first of all, that we all share the frustration at the lack of the pace, or the lack of pace. What I would say is that the work that the group did, particularly on the high priority area of lending, which has now resulted in that consultation paper from the central bank, and the one thing I would say is that our big concern is that while we did move away from the CUAC recommendation of a two-tier system to having the tiering captured in each of the regulations, if the principles that were set out in this group's report, because we were very much at one on this, that there are some principles that are set out. So, for example, no credit union should be restricted from services or limits that they currently provide. That consultation paper that was issued on the lending actually does that. It does actually roll back and restrict some of the activities that we currently can. So we do have concerns there. The automatic of inclusion in a higher tier for credit unions of a certain size and risk profile, We don't see that reflected. Now, what we are hoping is that, because, as Mr. Corr said, the recommendations from this group on the tiered regulations, to be fair to the Central Bank, came in after they had published their consultation paper on lending. So if we actually see the feedback statement and the proposed regulations on lending reflecting the very positive move to the asset basis and reflecting the principles of tiering that are recommended here, if we see those captured in it, then we'll have made significant progress. And just on can I address your comments on the digital side? That's something that we've got on with ourselves, and there's been quite a bit of work, right from realising that perhaps we weren't reaching out to a segment of members, by not using these channels. And we now have a situation where there are a number of credit unions where in excess of 20% of all their lending is now coming through digital channels. So we are making good progress, just to reassure you.
That's the first I heard of it.
Yeah, just to reassure you.
I'm going to go back to my point, because I'm actually tired of reading reports that essentially say the same thing at the end, and it goes on for another year. And I want to be helpful to the credit unions. So, can you give us in writing, give the committee members here in writing, a note on where you are with the things that you consider to be essential with the credit union movement? If it's a hold-up on the credit union side, tell us that, if you can't find agreement. And on the other side, if it's a hold-up with the Central Bank or the Department of Finance, tell us. Because someone has to, and Senator Donnan is back now, I want to say that, obviously he has done his homework in relation to this report and the questions he was asking, and his expression of frustration, I think, is felt by every member of the committee.
It's genuine.
Yeah, it's genuine, yeah. So
and it's
we want,
shared.
we want to ask you to complete the question, or the ask, to give us a report on where you believe all of this is at, not from the Department of Finance, not from the Central Bank, from the credit union representatives. Tell us where you're at, tell us what you want, and tell us who's holding it up. And be truthful. Because if you don't, we're going to be here next year, and you may be losing your audience in the course of that. And again, like the other senators here, Conway Welch and O'Donnell, we want to help. But all I see here is the various obstacles and reports, and I'm not one for that. I believe a business has to make a decision overnight. If there's someone holding up that decision process, tell us who it is, so we can ask them. Because while, is it Miss Byrne, is it, was part of your group and is not here today because of the Central Bank and the independence and all the rest of it. I don't accept that. I accept they're independent, but if they're part of a group, well, you're part of a group. I intend to, with the approval of members, have a further engagement with the Central Bank on this issue. And I would like to have that comprehensive document before the members so that we can clearly understand. Now, on the question that Senator Donnan put to you in relation to public banking, you're the nearest thing to public banking that I can see that we understand, but you're not quite there. You're not getting there, and there seems to be an intention to stall that process. Maybe it's to protect the banks. Maybe there's a vested interest somewhere along the line. Why is it that other countries can do it and we can't? And we have a perfect model here to do it. Now, so the question was asked as to why. And this is the answer, because it's contained here in your report. And it says here that thoroughly investigate the German Sparkassen model for the development of local public banks that operate within well-defined regions. That's what you were looking at, or that's what you were talking about. But the report came out then, and in that report, an investigation of the public bank indicate, given the current demand for and supply of credit, there is not a compelling business case for the state to establish a new banking system. So it's quite clear that they have no interest. And it's quite clear that some other players are going to have to step up to the plate here. And everyone is looking to the credit unions, the post office and everything else. So in the light of the government's position saying that they have no interest in it, can you tell the committee, where you're now going to go with this model of banking? Because it would seem that every step you take, there is an obstacle in your way to prevent you from becoming anything like a public banking system. Anyone want to comment on that? Yeah. Mr. Moran?
There are areas that, Mr. Chairman, thanks first of all for your invitation, and we certainly, I think, will take you up on that. And there are areas that need to be addressed. There also has to be a realisation process here that we are independent businesses. We are a different business model in that we are owned by our members. And it was stated earlier about the level playing field. There is certainly less than a level playing field here. We play very much against the hill in terms of this. The way in which we'll say regulations apply to other financial institutions, to non-financial institutions, and then to credit unions. And there are elements within the Credit Union Act that certainly we will be reverting to you very specifically on, practical ones. And again, could I say, look, not only do the bodies here share your frustration, but members share your frustration. And Mr. Chairman, you mentioned there the likes of N26 and Revolut and whatever else. And in terms of a simple process, if you want to sign up for those kind of services, you can do it online, you can do all of that kind of stuff. And a lot of credit unions have that technical capability and that ability, but the local AML and such regulations are very different, or seem to be very different, that apply to credit unions than apply to the likes of N26.
Mr. Johnson just told us that they're available.
They are available, yes.
And you seem to be telling us that they're not really available.
They're available. No, sorry. The actual technology is available, but there is a difference in the amount of hoops you have to go through if you're to sign up for N26 or for X credit union. And those are only.
So have you signed up
small
to the similar services provided by N26 and Revolut?
Have I signed up personally?
Not you, no, no. Is it the intent of the credit union to sign up to that type of digital banking? Because Mr. Johnson seems, and you know, I'm sorry putting you on the spot there, but you did give the impression.
And the actual technology is there. It's being implemented, being rolled out into credit unions as we speak.
Well, as part of your note to the committee, you might include your comments, some commentary on that, so that we can clearly understand where we're at with it.
Yeah, just to clarify, Chair, I spoke specifically about the sourcing of their, as I said, a number of credit unions are now, over 20% of their loans are coming via digital channels. So the two examples you gave are different services, they're not loans. So I'm just we're not necessarily talking like for like, but we are talking about the channels and the But that is a case, and in fact we've just even launched an actual CRM platform which a group of credit unions are sharing, and that is actually now going to allow them to plug in even further digital enhancements to make things like on-loan applications, member onboarding, all of that very seamless.
If you give us the information in a note,
yeah, absolutely.
That's what we want. My last puzzle I have is in relation to the money that you have to invest, right? I've been spending your €7 billion on social housing, as every other member has had, and nothing has come out of it. And then today there's another figure mentioned, €14 billion. So we know now why you can't invest directly in the individual housing agencies, recognised housing agencies, and why there is no investment being made in that vehicle that we were talking about in the context of a bigger investment at a national level. So where's the 14 billion and where's the 7 billion?
Sorry, well, one is investments and the other is...
Well, which one? The 14 billion is investment?
The 14 billion is referring to the savings that members would have in their credit unions.
And the 7 billion,
well, it's actually higher than that,
which is in the Irish bank, invested in Irish banks at the moment, is it?
Yeah, exactly. It's a part of their investment portfolio, yes.
And you can't touch it. You've nothing. You've no national.
There's no alternative
structure
at the moment.
there's no alternative for it. So it's there. It could be used, and the government simply haven't provided the platform, if you like, for it to be used in an efficient way to deliver social housing.
Yeah, I mean, as I mentioned earlier, the investment regulations were amended last February to allow a certain percentage be put in to a fund for social housing purpose, and that would be a little over 700 million would be the amount.
Yeah.
But for other reasons, that hasn't come to fruition.
Well, the other reasons you state, Mr. Johnson, are that the demand was not there.
The projects, in terms of because the approved housing bodies, the Tier 3 in particular, which are the only ones that we could deal with, their classification changed a month after the regulations for us came in.
Through your stat?
Yes, exactly. And so all of their funding, irrespective of the source, was regarded, or is now regarded as on balance sheet. Yeah.
And there's no other way that you can engage with the department to spend more than the 700 million in a different way that would allow you to do it for social housing, and that it would not appear on the balance sheet of the government.
Not the last part, but the first part of your comment there, I believe there are other ways we could actually provide the funding, and that would be through direct lending. And I know we did provide the committee before with a draft enhancement to the Credit Union Act to facilitate that. And again, we can put that in the document.
If you would, please.
Yes.
Yeah. I just have a couple of other short questions. The public service card being recognised as a form of identity for someone who has no other means of identification, why is that not in place?
Go on.
Our latest information is that the public service card could be used on a voluntary basis by the member if the member volunteered it, where the Act commenced. But the Act wasn't commenced. So I don't know why the Act wasn't commenced, but it is of severe disadvantage to an awful lot of people.
And have you any idea why the Act wasn't commenced?
Being honest...
Have you written to the Minister, whoever within the credit union would do that? And
no,
say, Minister, why has the Act not been commenced?
Again, we keep getting back this standard response that the member could volunteer it. We can't ask. They could volunteer it were the Act to be commenced. And we've not gone beyond that.
Chair, I'll come back to you with a short note. This has been...
Not the same short note that Mr. Ronan is on.
No, but I'll come back just to confirm the details, because it has been discussed in the task force that I mentioned in relation to the personal microcredit loan. My understanding is that it's a piece of legislation which is under Department of Justice and Equality, so it's not under finance and not under social protection, which run the It Makes Sense scheme. So I'll come back to you just to confirm that.
What you're going to do for me, Mr. Carr, is don't mind what they tell you in that department. pick up the phone and ring whoever is in the Department of Justice and just find out what the answer is.
Yep.
So that then as legislators we can at least bring it to the floor of the House and raise it.
Yep.
Nothing infuriates me more than that type of stuff going on.
Yep.
When people out there are really suffering in terms of wanting to have membership of a credit union because of their financial circumstances.
Yep.
If you wouldn't mind.
Yeah, no, do that.
The penny bank scheme, I call it a penny bank scheme, the money being collected in a local family resource centre, and it's been collected from a number of different individuals, and then it's been brought to the credit union and lodged. Why is there a question mark over that?
I didn't bring a note in relation to it, but
I'm not pinning all these questions on you. I mean,
yeah, but my understanding is that it's tied to money laundering for the credit union, which takes the deposit, that they have to know where that deposit is coming from, and therefore that there's an issue because it's collectively coming from a lot of different
these are not
people.
big amounts of money now.
No, I appreciate it. But that's my understanding. Is
so we're applying the logic of money laundering, or the issue of money laundering. We're applying it to people who attend on a Friday night to the family resource centre and give in the few bob that they've left over. And now they're being prohibited, aren't they, from doing that? Is that right? Where's that? No one answers. I mean, tell me, is that right or wrong?
No, that is it. I'm not saying it's prohibited, but it's exactly as
yeah, prohibited is the word, because they can't do it. Isn't that right, Mr. Carr? Or Mr. Molan, or Mr. Farrell, or Mr. Johnson?
In practical terms, under anti-money laundering legislation, and particularly the application of the regulations and the way that it comes down on one's staff, one has to, or one would have to be able to show the full source of funds, and that is, in practical terms, that is one of the outfalls of that credit unions are finding it easier.
So if I go over to my credit union and I've just collected €50 from 10 different people, and I say to you, that's from Mary and Joe and Anne and whatever, and there's €50 put into my account there. Not my account, but the account that's specifically used for that. Is that not acceptable?
Again, it's okay. It depends on. It will vary from credit union to credit union, but the credit union has to, when it comes to an actual regulatory inspection, and that would not come from the registrar's side, but from the anti-money laundering side, one has to be able to kind of show that one undertook due diligence.
I gave you the 10 names that I got it from and put it into the account for that purpose. Is that sufficient for the bureaucrats and the regulators?
Names would have to be all members, in theory, for you today. So if the 10 people were members in their own rights, and you had already their passport.
They're not at the moment, is that right?
No. But if the account is for the Molan family, it's very hard for him to do it right. If the account says Tim and you have the documentation for those 10 people already got from them,
will you be able to tell us where that legislation or that regulation is coming from in that report as well, so that we have it in writing for the members?
It certainly reflects kind of some of the practicalities of regulation. Ends up that we are caught between the devil and a rock and a hard place.
I understand that. I just want to get to the end of it here.
I think, sorry, Mr. Chairman, the word proportionate is very, very important.
Yeah. You might put that word into your report, and we'll see, can we explain it to the powers that be. On the microfinance end of it, and I think what Senator O'Donnell was referring to there was this €500. I think there's microfinance, and then there is the borrowings of people who are why the credit union was set up in the first place. And essentially, that's all about, as I call it, the penny bank as well. So, do you feel that there's an obligation, a kind of a corporate social responsibility, to carry some of those accounts? Okay, you might only make €35 on it a year, but you might be keeping someone out of the moneylenders. And I'll come to that in a minute because Mr. Moore has explained that.
Yeah.
So you don't mind doing it?
No, credit unions have always done that.
Yeah, I just want to make that point clear.
Oh, yeah, there shouldn't be any misunderstanding. Really, it's not about making €35. It's simply about trying to minimise the cross-subsidisation and just recouping some of the costs. But credit unions have always done that.
Yeah. Mr. Moran, you said that your ability to recommend business with another credit union. Are you not let do that?
We're not.
Why?
Because of everything ranging from common bond straight. Curiously, we can recommend business to kind of banks and stuff. We can't do it to one another.
Don't do that. Whatever you do, don't do that. Stick with the credit union.
But it's an important and it's a practical thing in terms of, we'll say, like there is a legitimate space for a credit union with 10 or 15 or 20 million in a particularly localised community. But we shouldn't have a situation whereby, and I know there's no kind of relativities to asset size and stuff like that, but where, for instance, we'll say somebody walks in to a credit union which is only 15 million in assets and they need something substantial, and they know that, we'll say, a credit union 20 miles distant can do it. And like, if you look at the models in, for instance, in Canada and the USA, this whole concept of this secondary market whereby the 15 million euro credit union can actually take the application, can process it, and can hand on the kind of the action part of it to credit union X further along the way. So again, like in terms of those, and like those are kind of some of the kind of things that we need to address.
That comes out of the common bond. As I said that.
That's one of the...
it's a change to the common bond.
Credit unions are
Well,
owned
that's
by their
Department of
members.
Finance, is it?
Yeah.
What do you think, Mr. Carr?
Well,
Way to change it?
It's not for me. I can talk about what we did as a group collectively. We reviewed this because the advisory committee recommended exactly what Tim has said. The advisory committee recommended that the credit union should be able to introduce business to other credit unions. As a collective, we didn't fully agree as a collective. So therefore, the recommendation, and I know you don't like these recommendations, is that further consideration is required.
No, I don't mind the recommendation if you're going to do something about it.
We just didn't get to a firm conclusion.
Why?
In.
Right, who was there? Let the credit union answer there.
I think it was just caution over
No.
the common
The
bond.
chairman is asking a specific question. To be honest with you, this is like extracting teeth, right? We actually want to help here,
Yeah.
but we're being stonewalled at this point, right? So the chairman has asked a very simple question. You're saying a collective. Let's break it down. The credit unions clearly wanted to change. So who didn't want to allow the referral system from one credit union to another for a loan? Who said no?
Sorry, the concept of common bond is an important one. It has
Accept that.
It has implications, in terms of, by their nature, credit unions are restricted bodies and operate to a restricted market. And I think the main caution was around that if we diluted the concept of common bond in any way, it just might open up some form of restriction. But then again, when you go back and when you look at it, there are credit unions whose actual common bond is the island of Ireland.
Yeah.
So there is potential here for actual movement on it. There is potential, to kind of expand the lending base somewhat, or more importantly, expand the service base.
But Mr. Moreland, you could still preserve the common bonds. So if I'm living in an area and some of the common bonds overlap, I'm living in an area, I go to my local credit union. That local credit union doesn't have the capacity to serve that loan. That credit union can do a referral. As far as I'm concerned, that's just an extension of the bond.
You said that they can do a referral.
No, I'm saying if you allow them to do a referral, they still go to their local credit union, but they're for us,
Isn't a referral, Mr. Moreland, isn't a referral something like, we can't do it here, but you go over there to St. Canice's credit union.
Yeah, but again, like, look, we want to be able to kind of do the thing openly, and like if, for instance, we'll say somebody at the minute was not actually living in the larger credit unions area, there could be potentially a difficulty. We don't want to be kind of doing this behind kind of.
I have to go to a vote, and I can
Just make one comment on that, Chair.
Are you asking for the question? You take the chair then. I have to be gone by half.
Just a very brief comment on that, Chair. Our view, and we've advocated for this for some time, the ability for credit unions to refer to each other, and really it's coming at it from a consumer perspective that nobody should be deprived of the full services of a credit union. That's the view we take on it.
And can I just say to you, because I have to go to that vote, that in all of this exchange this morning, right, you have to think of the staff on the front line.
Yeah.
And I have to say some of them are terrified that they'll do something wrong in relation to the regulation. So you ask a question, and I'm not saying every credit union, and I'm not talking about my own credit union, but if you ask a question, the staff will sometimes, there'll be a period of silence, and you can nearly hear the cogs rolling. I wonder, is that a credit, a regulation, not regulation? And it's not right. And I think as a collective, it's up to you to make that right. And the making of a right might not be in your own doing, but it may be telling us the truth of the matter. Who's holding it up? What is being held up? Describe the obstacles. Because I agree with Mr. Moreland, there are other lenders out there that don't have any regulation whatsoever, and they get away with it. And then there are the banks on the other end of it. They get away with everything. So I don't know what you're doing wrong. So if you tell us exactly what the truth is, we'll take it up with the Central Bank or the Department of Finance, but we need to know what you want done.
I think that's a very good challenge to pose to us, but I would say what we are trying to do is strike a fair balance. We do want to make sure that we are regulated properly. We do want to adhere to those regulations.
Mr. Johnson, I know that you do,
yeah,
right?
That's okay.
Just think of your members.
Exactly.
Just think of your members. They find it so difficult to understand all of this nonsense, when all they're trying to do is keep their head over water in terms of getting a loan, paying it back, and being right and making sure you're regulated. I saw my own credit union were fined recently. It was horrendous. It was a nonsense what the central bank did, and they should be ashamed of themselves. They should be encouraging credit unions rather than doing what they did, which is not. Anyway, you're going to give us that report. Sure. Senator Dunn, I can ask you.
Yeah, no, just following on from that, and this is just very briefly because I have to go as well, but that's why it was a surprise, because the bond, the restrictive bond, is such a big issue. It was a surprise that the implementation body didn't make any specific suggestions on what needed to be done. And I think that so it was observed that it was restrictive, but there was no recommendations made. And I think that's what I suppose the chair is looking for here today, that that there would be recommendations made, because it is a barrier, obviously, and it doesn't put the consumer at the centre of things.
Just on that,
and it goes against the whole ethos of credit unions.
Correct, and it's for all those reasons that we want to see this happening. But that being said, I mean, we are very cognizant of the value of the common bond and what it means. So really, and in the report, it's mentioned that this would be an enhancement to it. And the other thing that's in the report as well is that while this group has finished its work, the group is actually going to continue. And hopefully, it's issues like that we'd like to see through to fruition.
Yeah, because I think we all you know, we see the evolvement, but the evolvement isn't fast enough and it's not pertinent enough. And we're looking at a situation again where we have so many external factors, Brexit, China, Italy, trade war in America, all of these things, you know, the end of quantitative easing, the cumulative effect of all of those. We really need for the credit unions to have as much flexibility as possible to be able to adapt to the needs of their consumers who trust them. So we need to trust you, and we just need to know, and I think that's a very good suggestion by the Chair in terms of knowing specifically what we need to do. We can't keep having the same conversation over and over again while we take that there has been some evolvement around it. And we need some, you know, truths around the relationship with the Central Bank as well and with the Department of Finance in what we're here to help, we're here to assist, but we're going to run out of road in terms, I suppose, even of the work of this committee and what we need to focus on and the progress that we need to make.
And I might add to that, when you're sending it back to report to the committee, not only you'd address the issues, but maybe you might address the solutions, the directions, the actions that should be taken to enable us to get to a point where we're here to help. But the problem is that, and if I could just do one question, I meant to ask it earlier. At this stage, are there any credit unions in trouble? Because in terms of the restructuring of credit unions, I suppose I'm looking to get to a point where the credit union movement as an entire body is in good nick. Like, obviously Charleville was more recent one. At this stage, are there any credit unions up and down the country that are currently in trouble that require to be merged or restructured or whatever? I know it's a hard question, but it's an important one.
I think I'll just comment at the start. I think in terms of the credit unions who have low reserves, I think there's very few. The Central Bank published data recently. I think there's extremely few who have low reserves at the moment, and I think generally arrears have been trending lower. Capital levels have been trending higher. Liquidity has been pretty good.
Are there any further amalgamations or mergers in the pipeline proposed?
So there is a Central Bank registrar gave a speech last weekend at a conference, and I think he confirmed, and we just confirmed these figures. They're in his speech. I think he confirmed there were 16 mergers last year, and that there's 16 in the pipeline for 2019. So out of a scale of about 260 at the moment, there's 16 in merger discussions expected in 2019.
Mr. Farrell will be very much in your. Do you anticipate that mergers will become a continual feature, or are we going to get to a point where you'll come to a conclusion around mergers, that the process will be concluded, or is it going to become a feature?
The number is reducing, but I don't see it, you know, coming to an absolute conclusion. I mean, there is 16 last year, there's going to be 16 more, so maybe there'll be a dozen next year, so certainly it'll be down to 200 credit unions when that goes through from 400. And if you look to the American or Canadian or Australian experiences that we've all alluded to earlier, I think there was 26,000 credit unions in the States, there's 6,000. So if it trends along those lines, I don't see it ending, but progressing at a slower.
And do you see at a level at which the credit union movement as an entity would require what would be the critical mass of the number of credit unions? So if for it to be a sustainable model, are we looking at 200, 150? Is that too hard a question?
Well, again, they're all individual entities owned by their members, so it's not sustainable. You don't add them together to get sustainable or not. Each of them makes those decisions, and as Brian said, that there's a handful or a half a handful of low reserves, so they are sustainable, but for local reasons the boards and members have agreed to merge with their neighbours in 100 and something cases in the last few years, not necessarily because they weren't sustainable. It was to maybe access better services for those members, not least because of that common bond issue, I suppose, that we spoke about. Where
and the final thing, has the credit union movement as an entirety considered putting a proposal to both the Department of Finance and to the Central Bank in terms of a specific public banking hybrid model. I mean, when I'm looking at public banking, I'm not talking about the Sparkassen model. Sparkassen is just the one everyone quotes. I'm more interested in the services it provides as distinct from its structure. Credit unions continue to be separate independent entities, but they have a network which is unrivalled. We're a small country, and yet we have this fantastic community-based model of credit unions up and down the country with a huge amount of public trust. I mean, I was quite amazed on my dealings with credit unions. The loyalty of the members to credit unions over the last 10 years was incredible. In a lot of cases, many of them should have left their locals. They didn't. They were loyal. It's incredible. And so I suppose I'm putting it really, I suppose, to everyone there, and obviously principally to Mr. Farrell and to Mr. Johnson.
The biggest difference, I mean, we, as I said, the population base of Germany, so if you divide it by factor 10 or 15, the public banks are owned by the government in Germany. The public banks called credit unions are owned by the members here. That's the biggest difference.
It's a model. Have you considered?
We are the model. You know, we don't see any much difference in it.
Yeah,
What?
I would say that
The credit union movement and the public banks other than the ownership.
I think really what we're saying is that and we have discussed this collectively as well, and we've been at various committees about the public banking. Our strong belief is that all of the strengths that people see in a public banking model, we believe the foundations are well and truly here in the credit union movement that we have.
I'm agreeing with that.
So really it's a case of not trying to create something new. It's about how do you get those services then through the credit union system, and that's where things.
You're not looking at a formal application. You're looking at evolving the system that you currently have to a point where it's providing the services.
When you consider the last 5 years, we have spent really focused on strengthening the governance, strengthening the prudential management of the credit union. Now we're very focused on how do we now take that sort of strength. So we have it now through financial strength and competency strength. How do we now start to deliver more for people, and then making sure that everybody can get access to that. And when we have, and as we are
the point I'm making, Mr. Johnson, in a roundabout way, is the point I'm making is, would it assist the credit union overall if they were to, I know in substance you're doing it, but in principle to put forward to the Department of Finance a proposal that there is a need for an enhanced, to fill that gap of public banking, and to do that, credit union movements require certain changes to take place. Limits around the bond, around whatever, and that it would be used in its own way as a conduit by the credit union movement to allow them, but to put some form of structure in place, because the problem here is over the years, is it's over and back, it's over and back. The bottom line here is we need to get to what does the credit union movement require now to enable us to be able to provide a range of services in a modern, functioning financial services global economy, but at a local level. And I just feel I'm hanging the hat around the term public banking, but I have no particular hang up with that term, but I think there is a need, and we're getting it from members of the credit union. We're getting it from the credit union more over the years, that the restrictions. So I'm putting it and framing it in a way that, Mr. Molan, I'm framing it in a way that would allow the credit union movement to look for those changes that it requires.
Mr. Chairman, you referred to some of these outcomes, really, and I get the feeling you're more interested in outcomes than in terminology.
Correct.
And we'll say, the very generous invitation by Mr. McGuinness and by the committee to actually submit and discuss and address those issues. That certainly is one of the areas there whereby there are ways in which, but it will need legislation, whereby the whole concept of, for instance, the use of CUSOs, of credit union service organisations, can actually be harnessed and can be done in a responsible way, as Mr Johnson said there, in a regulated and whatever way. There are ways in which those have been successfully done in other jurisdictions, and again we certainly will reflect that in our submission to your good selves.
Thank you.
I'll just finish up with public banking, because I do think, as you say, other jurisdictions, there are other jurisdictions that have very successful models of public banking that sit alongside the likes of the credit union, and it's something that we will continue to pursue here on the Finance Committee. I know the government are reluctant to look at it, but it's something that we are very actively looking at, that will be, will be implemented, I would hope, at some stage.
Chair, can I just make one comment in relation to local public banking? So the report from the Department of Finance came out last year. One of the outcomes of that was a recommendation that there be an independent evaluation of local public banking. My understanding is that that procurement process for the independent evaluator is effectively complete and will be announced in the next few weeks.
To appoint a consultant.
To appoint a consultant to do the independent evaluation. The terms of reference for that independent evaluation have already been agreed. Credit unions are specifically referenced as one of the potential delivery mechanisms for local public banking. And I suppose lastly, some of the things we referenced in the report, the rollout, hopefully the successful rollout of debit cards and current accounts to a good proportion of credit unions this year, the extension of the mortgage lending limits, and some further work that credit unions are doing behind the scenes in relation to SME lending will get you a fair bit of the way towards where we are now, towards where we all consider that the services of local public banking, not necessarily the wording, the services are provided by the credit unions.
Mr. Carr, we can't expect the credit union movement to step into that space while at the same time tying their hands behind their backs in terms of the services they can provide. That's where we as a committee step in. Mr. Moreland kind of encapsulated what I'm about. It's all about outcomes for me. And I've dealt with credit union movement at every level all my life, both as a member and as an accountant. I know what they do, and I want them to step into that space because it's required. Can we take, Mr. Carr, that report is being done, the independent report, would be a copy of that will be provided to the committee on its conclusion. Can you pass that on?
I'm not sure if it's a final report or what the process is, but we'll confirm what the process is, and I suspect it will be announced in the next few weeks.
Can I thank all the members, the representatives for coming today. It's been a long day, but hopefully it will end up being a productive one. And the Joint Committee is now adjourned until 2 p.m. next Tuesday, the 5th of February. So thank you all very much for coming.
Thank you.
Thanks.